Good morning. I'm Christopher Sidko, Senior Staff Counsel with the Department of Insurance, and I'm going to open our hearing today. This hearing is regarding the proposed revisions to the Insurance Commissioner's regulations pertaining to classification of risks, recording and reporting of data, and experience rating for workers' compensation insurance, and the approval of advisory pure premium rates and the workers' compensation claims cost benchmark. This is to be effective January 1st, 2013, and our file number is REG 2012-00016. We received a filing from the Workers' Compensation Insurance Rating Bureau, an insurer rating organization, regarding the rule changes and pure premium rate adjustment. That was amended on October 1st, 2012, and addressed the substantial legislative reforms that were in SB 863. We did provide notice of this proceeding through notice of proposed action, and public hearing was issued August 28th, 2012, along with an initial statement of reasons for a hearing to be held on September 24th, 2012. Subsequently, and as a result of the legislation that needed to be analyzed, the hearing was canceled and the matter continued for the amended filing from the Rating Bureau. An amended proposed action and notice of public hearing was issued on November 7th, 2012, with an amended initial statement of reasons for today's hearing. This matter is being held pursuant to Insurance Code Sections 11734, 11750, and 11750.3. The record in this matter is going to be closed today, November 16th, 2012 at 5:00 p.m. In addition to the testimony being presented today, additional written comments and evidence may be provided up until the time that the record is closed, unless further time is granted at the end of these, before the end of these proceedings. Testimony today will be recorded by the reporter, who is to my right, and there will be a transcription of the testimony available. Copies of the transcript, if anyone would like to obtain it, should be requested from the reporter, and the reporter has cards to provide at the end of the hearing if you would like that. And in addition, we'll provide contact information later on if anybody needs that. I would like to admonish everyone that does come forward to testify today to please identify yourself with your full name, and if you do represent somebody, who you represent. If you come forward and testify, please also speak loudly and clearly so the reporter can take down what you say. Also, please respond, if we ask questions, respond to them verbally, nodding your head, shaking your head, going doesn't come out on the record very well, and we'll remind you so that we can get a clear record of the proceedings today. Also, please do not speak too quickly. I've told the reporter that if someone does speak too quickly, she can tell you to slow down, and I'm sure she will let you know. With that, I wanted to let you know that the order of presentation today is that we will first hear from the Rating Bureau regarding its filing. We will then hear from the public members of the governing committee of the Rating Bureau and their actuary. And then finally, we'll take in any public comment or testimony that anyone would like to give. If you are going to provide to us documentation, I'll receive that and we'll make sure that we note that in the record today. And I'll try to summarize all the documents at the end of the proceeding. The panel here today includes myself, Ron Dahlquist, our Chief Actuary, and Insurance Commissioner Dave Jones. And with that, Commissioner Jones, if you would like to make an opening statement.
Thanks. Welcome, everyone. I want to apologize first and foremost about the venue. I feel a little odd being up here on stage, and so I hope you bear with us. But we're most appreciative that you've taken the time to attend, and we're very eager to hear your testimony as the proceeding moves forward. As was explained a moment ago, the purpose of the hearing is to evaluate the costs in California's workers' compensation insurance system as laid out in the pure premium rate filing and analysis from the California Workers' Compensation Insurance Rating Bureau, or WCIRB, and we'll have a chance to hear directly from them in a moment. I think it is important, though, particularly for those members of the public who are not as familiar with this process, to underscore what exactly we mean by the term pure premium. Pure premium is often misunderstood by the general public and employers who are required to have workers' compensation insurance. Pure premium is the portion of the premium needed to cover the insurer's claims costs and claims handling expenses. Workers' compensation insurers are free to set their rates wherever they choose, with one exception. Those rates have to be sufficient to make sure the companies remain solvent. And it wasn't too long ago that over 30 workers' compensation companies in California became insolvent, with terrible consequences for employers purchasing workers' compensation insurance. Prices shot up, insurers that were not insolvent exited the market, the Department of Insurance had to take over many insurers, employers had a hard time finding or affording workers' compensation insurance. Again, it's important to underscore the insurance commissioner nor the Department of Insurance do not set workers' compensation rates. Anyone who tells you that the insurance commissioner sets the rates is simply not telling you the truth. And it's particularly disingenuous for publications, publishers, or reporters with reported expertise in workers' compensation to tell readers that the commissioner or the department sets rates. These so-called experts know better. The law does direct the insurance commissioner to issue an advisory pure premium benchmark rate and rates after receiving a recommendation from the Workers' Compensation Insurance Ratings Bureau. This is important so that insurance carriers and the market and employers and brokers and agents have good information about costs in the system and to assist carriers in setting rates so as to avoid insolvency. While no one likes increased rates, there is something far worse: insolvency of insurers, shortage of insurance, and then prices rocketing even higher, as occurred only a short time ago in California, with disastrous consequences for our economy. Indeed, past commissioners have been hesitant to issue the advisory pure premium benchmarks because of the misreporting that commissioners actually set the rates themselves. But again, the pure premium advisory rates and benchmark are exactly that, advisory. Insurers are free to set rates under our laws as they see fit. Now, earlier this year, the legislature and the governor enacted an important package of workers' compensation reforms through Senate Bill 863. These reforms had two major components: increasing needed benefits to permanently injured workers and cost savings. I applaud the hard work of stakeholders, which included labor and employers, in fashioning these reforms, and applaud the legislature in passing SB 863 and the governor and his staff in supporting the legislation. With the passage of SB 863, we need to measure, as a part of this proceeding, any costs and savings for the entire workers' compensation system associated with the SB 863 reforms, as well as measure and evaluate underlying cost pressures that are occurring in the system concomitantly. The first major component of SB 863 provides for an increase in permanent disability benefits to injured workers, benefits that previously were inadequate. Utilizing objective criteria to determine impairment and providing limits on what can be compensated, the permanent disability reforms also help to address areas of potential abuse. The second major component of SB 863 provides for system reforms, particularly associated with the delivery of and payment for medical treatment, resulting in projected cost savings to cover the permanent disability increases and bring additional savings and stability to the system. These reforms include independent review of medical treatment requests and billing disputes. Additionally, problems that we have seen with the filing of medical liens are also addressed, providing for more potential savings. The workers' compensation system has struggled to stabilize rising costs over the last few years, particularly medical costs. The tools that employers and insurers use to control medical costs have not been as effective as we might wish, or were underutilized in some cases. There have been double-digit annual increases in medical costs. The SB 863 reforms put in place an opportunity for additional decreases in medical cost inflation and further system stability, and in turn will assist with making the costs in the system more predictable. After reviewing the SB 863 reforms and trends in the workers' compensation system, the WCIRB Actuarial Committee recommended a pure premium benchmark of $2.61 per $100 of payroll. The WCIRB Governing Committee instead is recommending a pure premium benchmark of $2.38 per $100 of payroll. The purpose of today's hearings is to take testimony and evidence with regard to the WCIRB's recommended pure premium benchmarks and rate filing. Based on the testimony and evidence from this hearing, I'll then issue a pure premium advisory benchmark. So with that, why don't we hear from our first witnesses, the representatives from the Workers' Compensation Insurance Rating Bureau. We want to welcome them to the hearing and are most appreciative of their spending time with us this morning and setting forth information for us with regard to the rate filing. Welcome.
Thank you. Good morning, Commissioner Jones, Mr. Sitko, Mr. Dahlquist. I'm Bill Mudge. With me is Dave Belusi from the WCIRB. This morning we'll provide a brief summary and perspective of the advisory pure premium rate filing we recently submitted for your review. We too recognize that pure premium rates issued or approved by the Insurance Commissioner are advisory only and that insurers are not required to use them. I will make a few opening comments and observations and then ask Dave to expand upon our actuarial analysis of the underlying cost drivers that have been contributing to the ongoing upward escalation in claims costs, and we'll provide perspective on our evaluation of the costs and savings that we have quantified to date from Senate Bill 863. We will provide this morning some context for our proposed January 1, 2013 pure premium rates, including our current actuarial evaluation of the impacts of SB 863. We will touch on SB 863 provisions that remain to be evaluated pending promulgation of regulations by the DWC. We'll also share risks we see in terms of potential new consequences from SB 863's structural reforms, and equally or maybe more importantly, our action plan to closely monitor the cost effects and trends of the legislation and regulations and to report our empirical observations as quickly as practical to you. There's no question that since the reforms of 2002 through 2004 were fully implemented by 2005, that since that time, ultimate claims costs adjusted for the effects of frequency in the California workers' compensation insurance system have been steadily going up. If we look at this slide that I'm now showing, which we shared at our mid-year rate hearing, we see the context for our concern with this ongoing upward trend in the indemnity cost index as depicted by the green line on the top there. This claims cost level, indexed starting at 2005, shows a markedly higher trend than the index of average wage level growth or the underlying exposure base in the system as shown on the tan line. Said another way, workers' compensation claims and resulting costs have outpaced the California economy and have been putting upward pressure on indicated pure premiums. And no doubt, this disparity in claims costs to exposures was a driving force for the systemic change that we now have in SB 863. Looking at this slide a bit further, we show the top line there, the top dotted orange line, reflects our actuarial projection of costs for 2013 using data as of June 30, 2012, but with no SB 863 impact. If you will, that top orange dotted line is the world pre-863, as if the system continued the way it has. The blue dotted line in the center shows how that cost line flattens based on our actuarial estimate of the areas we believe are currently quantifiable within SB 863. The bottom line, the red dotted line, depicts a downward trajectory in costs based on a greater reflection of savings from SB 863, aligned with our amended filing, and is in recognition of the unusually high level of uncertainty surrounding yet to be developed regulations and the potential for additional savings from SB 863 beyond that which is currently quantifiable. Dave will provide more detailed perspective on SB 863 in just a moment. But if we bring then, though, the composite of costs together with payroll in terms of an advisory industry pure premium benchmark, this slide provides a relevant range of those perspectives. Starting on the far left, $2.38, that's the insurance industry's average filed pure premium rate as of July 1, 2012. Moving to the right, next to that, $2.68, is our indicated average January 1, 2013 pure premium rate from our original August 21 filing based on, at that time, March 31, 2012 industry loss and loss adjustment expense experience, and using methodologies that were similar to the filing we made for July 1, 2012. Moving across at $2.73 is an update to our August 21 filing, simply using now June 30th, 2012 industry experience, which reflects about a 2% deterioration from the March 2012 data. The next, at $2.86, now adds in just the permanent disability benefit increases that were spelled out in SB 863. So this indication at $2.86 is a reflection of now our best experience through June of the industry and just the benefit increases from SB 863, an indication as if no reform savings were to occur. Now $2.61 reflects now the savings from the areas that we, the WCIRB, have actuarially quantified at this time. Areas of SB 863 that are dependent upon regulations yet to be promulgated, and speculating on the potential impact on costs and utilization of medical treatment from the new independent medical review process within SB 863 are not included in that number. $2.38 on the red bar there reflects the amended filing we submitted to the Department of Insurance on October 1, based on no increase in the advisory pure premium rate level for January 1, 2013. That was in recognition of the uncertainties around the potential for additional cost savings from SB 863, components that have yet to be quantified by our organization. Now clearly, several of SB 863's provisions do aim directly at many of the key factors that have given rise to the upward trend in loss costs since the last major reforms of 2002 through 2004. The magnitude of those potential savings has been and is the focus of much actuarial debate and professional dialogue. Finally, the last bar shown on the chart, we've appended from a preliminary estimate from the Department of Insurance of average filed pure premium rates from a number of companies that have submitted filings now for January 1, 2013. And that number in aggregate is $2.49, up about 5% from the July 1, 2012 benchmark. I'm going to turn the rest of our presentation over to Dave Belusi. He'll provide more in-depth analysis of our SB 863 evaluation, and equally important, as I said, our plans for ongoing monitoring of its effects on industry loss costs. Dave?
Bill, before we do that, I'm just wondering, just to help the thing flow, I have a series of questions that I wanted to pose to you, and then maybe we could go to Dave's testimony, if that's all right?
Sure. Dave and I might answer those
I understand.
together.
Absolutely, absolutely. So, what strikes me is the dramatic difference between what the WCIRB Actuarial Committee recommended as the actuarially indicated pure premium rate, considering all of the consequences of SB 863, and what the governing committee adopted and sent forward with the rate filing. So I'm wondering if you could explain for us in general the process that the governing committee uses to make its decision about the pure premium rate benchmark and pure premium rates generally.
Right. I will say that the governing committee meeting, some of our committee members are here present today, was not without significant discussion and debate on this issue of what are the magnitude of potential savings from SB 863.
But let me clarify. I'm interested in how it's done generally, and then I do want to drill down in a moment to what specifically happened at that governing committee.
Fine.
But just generally, if you could provide
Sure.
an overview of how it's done,
Sure.
that'd be helpful.
So in open session, staff, Dave, our actuaries, myself, we present the work that has come forth from the actuarial committee to all of the members of the governing committee. They get a detailed amount of information in advance of our meetings, and there is a unlimited amount of time available for committee members to question staff, to dialogue on the materials that they have received, and to make sure that there is a understanding from their perspective on what staff is recommending to the committee for its consideration.
And what did the WCIRB Actuarial Committee recommend to the governing committee with regard to this particular amended rate filing?
Right. Dave, do you want to cover that question in as much detail as the commissioner would like, and then I'll jump back in.
Good morning, Commissioner. Yes, the process, let me describe a little bit, because this was an unusual process given SB 863 and the enactment. The Actuarial Committee went through a fairly detailed process. There were 2 meetings held in September that were public meetings from the entire Actuarial Committee, as well as a number of people from our claims working group, which consists of insurer, claims personnel, legal personnel, researchers, and plus a broad range of other experts in the workers' comp system, representatives from the Division of Workers' Comp, your own staff from the California Workers' Comp Institute, the Commission on Health and Safety, UC Berkeley, and others. So a very broad group. And that group, looked at the provisions of SB 863 very closely, and in many instances, as I'll talk about a little later, there was, informed judgments made, and those were reflected in analysis that was presented to the governing committee at their meeting and summarized, as Mr. Mudge mentioned, in a fair amount of detail. The indication based on the actuarial committee's evaluation of SB 863 was a net savings of about 4.4% when combined of the bill, 4.4% from SB 863, when combined with the latest June experience that would produce the indication shown up there at $2.61. The combination of the most current loss experience reflecting the deteriorating trends that Mr. Mudge alluded to earlier, as well as the actuarial committee's consensus reflection of the impact of SB 863.
And just to, since we're on this point, so over what period of time was that analysis prepared?
Well, the analysis really started even before the legislation was passed. Once we were requested by yourself as well as the Director Baker of the Department of Industrial Relations to try to assess some of the proposals that ultimately turned into SB 863 in the latter part of August. Staff worked with and consulted with a number of these on an individual basis. We didn't have the opportunity to bring the actuarial committee together, but we consulted with a number of experts individually throughout that process, all through the last couple of weeks of August. Then we had an initial meeting on September 5th, shortly after the bill was passed on August 31st, that included the actuarial committee and the claims working group, as I alluded to earlier. At Mr. Sitko's request, we came back. There were some open issues that we needed a little more discussion, pull a little more data together, so we came back and met, I believe it was September 16th. I could be wrong on that date, but we met again in September, and then ultimately built the analysis based on that process, built the analysis that was presented to the governing committee on, I believe it was September 26th.
So about a month and a half, maybe 2 months of analysis?
That's correct. I guess from the early staff analysis from the middle of August until went to the governing committee at the end of September. And even beyond that, as you may recall, we made one slight amendment to it based on some new information that we gathered that was submitted on October 12th. So it is in many ways, it is an ongoing process. As regulations get adopted, estimates are going to be evaluated. So it's we don't feel we're anywhere close to done, and we won't know with good certainty for a couple of years what those real costs are.
So about 3 months of analysis, then all told, to bring us to where we are
Yes.
today. Then you alluded to some of the individuals and groups that were involved in doing that analysis, but can you be a little more specific about the individuals and groups that were not involved in that sort of 3-month analytical process?
A little more sense about the groups that were involved?
Yeah, or the individuals, or who does this analysis, I guess, is the better way to ask the question.
Well, there are a number of organizations that were doing components of analysis independently. CWCI published some information. Mark Priven from Bickmore Risk Associates for the department published a number of analyses. The Commission on Health and Safety and Workers' Comp have done some things in the past. State Fund, I think, published some estimates. So there was a wide range of groups that were doing work on this. We reviewed all of that and consulted with all those parties involved. And we brought all those parties together around the table. As I mentioned, Locke Taylor was involved from the Commission on Health and Safety and Workers' Comp. Alex Swedlow and Michael Nolan from CWCI, Mark Priven from Bickmore Risk Associations, representatives of the Division of Workers' Comp. Some of your own staff were involved in some of those meetings, as well as WCIRB staff who were leading the process, as well as a number of insurer representatives who are on our committees or working groups, some of which come from a claims perspective, some of which come from a legal perspective. So it was a very broad group of experts, very diverse in research, in actuarial, claims, legal. It was, again, a very broad group of experts.
I want to just say CWCI means California Workers' Compensation Institute.
Oh, thank you.
I just want to make
It's
that
just for
clear
the
for the
reporter's
record.
help.
Yeah.
And then in the course of that analysis and that discussion, deliberation, that broad analysis and discussion, deliberation that you described, was there discussion on the part of the actuarial committee with regard to the merits or dismerits of available data sources in reaching the conclusion the committee reached?
Yes, very, very much so. And each provision of SB 863, each of the key provisions, there were many diverse provisions, as you're aware, sort of has its own issues around it. And sometimes there were very good data and very direct data that the computation was relatively straightforward. And in other issues, in other areas, there was a consensus that a particular provision will save costs. And I'll give one example: the impact of independent medical review on temporary disability duration. Temporary disability duration has been growing in California. It's well above other states now, and it's been growing steadily deteriorating. I think there was agreement that part of the reason for that deterioration over the last 5 years was delays related to medical treatment disputes. Well, independent medical review, if it works as we all hope, should reduce those delays, should result in quicker decisions on medical treatment disputes. That's going to have an impact on temporary disability duration. Exactly what that impact is a matter of judgment. So as a group, there was discussion. There was no way to directly measure that, but as a group, there was a consensus about a reasonable, assumption on what that impact on temporary disability duration would. That's one of the extremes where there was a consensus in terms of savings would be materialized, but very difficult to come up with a precise estimate. In other areas, for example, benefit increases, those are fairly straightforward. They're very real. They don't depend on implementation regulations for the most part. It's a fairly straightforward, traditional actuarial process to measure those. So there was less discussion and less computation. So it's a wide range of things where the data is very solid and traditional standard actuarial methods to value the impact of those, and then other areas where there was limited data and even no direct way to do that, but ultimately when there was a consensus of the group that there would be some savings, the group built a consensus around a reasonable estimate.
So it sounds like in the course of reaching the actuarial committee's recommendation, which was essentially $2.60 per $100 of payroll, but just recently modified to $2.61, that the committee and the experts and the staff weighed alternative estimates and evaluated them and decided which ones they thought were reasonable and which ones not so reasonable in reaching their conclusion.
Yeah, that's a fair assessment, Commissioner.
Okay, and then I guess with regard to estimates of costs and cost savings, I mean, I take it that the committee operates by consensus?
Typically by consensus, though. Ultimately, the actuarial committee, there are issues when there's a difference of opinion. We will take a vote, and so it's a combination of consensus where there's a relative unanimity among the group, but if there's a strong differentiation of opinion, we'll take a vote and move in terms of majority. And at least in one instance, and maybe two, there was some differences of opinion, and there were a split vote at least one instance in that discussion that I recall.
And just out of curiosity, what was the order of magnitude of differences in cost savings associated with those two items for which there was a split vote?
Well, the one I recall, and I can clarify better, was a difference in terms of the impact of changes in claim benefits on the impact on claim frequency. It's kind of known as the utilization factor. There was agreement that there is a utilization factor is appropriate. Some disagreement on the magnitude, but my recollection, it was the differences of the impact were very modest. Maybe less than 1% on total costs. So it wasn't, while there was a difference of opinion and ultimately a split vote on it, the bottom line result of the two differences were relatively modest.
And so just to be clear, the split vote was just on those two relatively modest items. With regard to the final actuarial committee recommendation of $2.60, was there a split vote with regard to that recommendation?
Well, just to clarify how the committee operates a bit, the committee doesn't make a decision about what the final rate indication is. They make a decision about methodology. So each component of the bill, we came to a consensus or a vote on what would be the saving estimate. We didn't put the numbers together, and they didn't adopt 261. They looked at each of the components, and then staff put all those assumptions together. But I would say, I think to the substance of your question, there wasn't areas where there was disagreement on the committee were relatively narrow and wouldn't have a major impact on the $2.60 and later adjusted to $2.61 indication.
Okay, great. And then let me, if I could ask Mr. Mudge to come back, because I just wanted to continue some questions I had about the process then of the governing committee as distinct from the actuarial committee. So it's my understanding that the actual committee then did recommend a pure premium benchmark of $2.60 to the governing committee. And I take it that as you explained, Mr. Mudge, the governing committee had that recommendation in front of it when it took its action, ultimately adopting a recommended pure premium benchmark of $2.38. So it had the actuarial committee's recommendation in front of it at that time?
Well, again, just to clarify on what the actuarial committee recommended, as Mr. Belusi said, the actuarial committee recommended and had consensus and discussion about methodology and impact of components of SB 863, and then staff actually worked the calculations that then resulted in the output being $2.60. So the actuarial committee did not recommend a claims cost benchmark number. They directed staff to use what they came to agreement about in terms of process and elements, and then staff worked it into that advisory pure premium rate calculation.
Well,
but all of that information, actuarial committee work, background, and such, and then all of staff's work around that certainly is all available and was all available to the governing committee members.
And I would imagine the benefit of doing it that way from a process standpoint is it at some level, if you will, depoliticizes the concern about what that ultimate rate might be. If the committee is reaching conclusions about the component parts, and then without having to be too concerned about what the ultimate outcome is, and then the staff essentially does the math and then presents that result to the governing committee. Is that correct?
That's a fair summary.
Okay, and then so I'm still struck by the dramatic difference between what the actuarially indicated pure premium benchmark rate would be of $2.60, or is just recently adjusted $2.61, versus the governing committee's pure premium benchmark decision of $2.38. So I'm wondering if you could share with us what the rationale was that the governing committee had for so dramatically departing from what the actuarially indicated rate was.
Well, as you know, those are open meetings. The governing committee meeting was an open meeting. I think the process and result of that specific committee meeting was chronicled by the media, and as you know, and I'll summarize for you, it was anything but a clear, bright line in terms of what that outcome would be from the committee. In fact, it was as close a vote as you could have.
Of the governing committee? Of
the governing committee.
Yes.
Yes.
It was a split vote.
Very split vote, with 6, 4, and 5 against the motion that was on the table, which ultimately then did pass in vote to make no change to the advisory pure premium benchmark. There was a lot of debate in that meeting and a lot of discussion, but ultimately when a vote was called for on the motion on the table by the chairman, that's how the vote came down.
So then, just to be clear, because you're right, there was a split vote. With regard to the majority that supported the motion, what was the rationale for so significantly departing from the actuarially indicated pure premium benchmark?
Yeah. I think you could ask some of them who are here today, possibly, but I would say that my take on the dialogue and discussion that led up to that was a function of, one, understanding the actuarial work that was done by the actuarial committee and then subsequently staff, and respecting that work, but also with a belief and I think a lot of maybe historical expertise and experience vis-a-vis the system when there is major reform, that there's a great degree of uncertainty around what ultimately the savings from the system will be. And I think there was certainly on the table and well discussed the recent reforms, the last set of reforms from 2002 through 2004, that ultimately, when hindsighted on how those reforms worked out, by far and away, the savings exceeded anyone's estimates that were made, even the ranges of estimates that were made at the time. And so I think there was some sense among some of the committee members that this set of structural reforms could equally have, maybe not to the same degree, but could equally have savings that would surpass what the best estimates were at the moment in time. I think that was probably among their thinking. I think the other element that was among their thinking was the fact that we at staff and also the actuarial committee felt that there are areas for potential savings within 863 that we just can't value at this point in time. We're pending regulations to be adopted, and I think there was significant discussion about what exactly independent medical review would do, not to the dispute resolution and administration of benefits, but what will it do to changing medical treatment and medical utilization patterns within the system. Medical, as you know, is such a significant part of the totality of costs in comp that even a very minor or modest movement in a positive direction relative to medical trend can have a significant impact ultimately in what a claims cost benchmark number would be. So I think, to sum up without actually being in their heads and such, that I think they were reflecting on the significant benefits that came from the last set of reforms that far surpassed the actuarial thinking at the time. And secondly, that their belief, and many of them I think were actively involved in the legislation itself, a belief that the areas that we could not evaluate at this time would have significant additional savings. And given that and the uncertainty around the potential benefits, there was I think a sense and ultimately a decision among the majority that this would not be the time to go forth with a rate increase or advisory pure premium rate increase to the system.
The cost savings delta associated with the actuarially indicated pure premium rate coming out of the actuarial committee's work versus the governing committee's majority split vote recommended pure premium rate. What's the actual cost savings necessarily implicated by those two different figures? In other words, to get to the governing committee's recommended pure premium rate, how much additional money would have to be saved in the system in order to achieve that pure premium rate?
Right. No, it's a great question, Commissioner. We've actually looked at that, and I'll ask Dave to step back up here and give you the specifics. We've looked at it a couple of different ways.
Okay.
Yeah, it is. I
just need the number.
Pardon me?
I just need the number.
Yeah, the number, it's about 3 to 1 roughly. So I mentioned that the savings we estimated were about 4.4%. From the actuarial committee.
Can you give it to me in absolute numbers?
In dollars?
Yes, sir.
Yeah, in dollars. I remember my dollars, so I'd have a chart that'll clarify it. The savings from the reforms were about $1.7 billion that we quantified. That would have to double, roughly, Tony?
Yes.
It would have to more than double to produce the savings. So we'd be talking about another $2 billion, roughly, in terms of savings.
Okay, so just to be clear, so the savings identified by the actuarial committee's extensive 3-month evaluation were about 1.7
roughly, it was
billion?
about 1.6, 1.7. Those are the savings of the reforms, not the net, because there were benefit increases.
I understand.
Right.
But the additional savings on top of that $1.7 billion in savings associated with SB 863, the additional savings that would have to be assumed in order to reach the governing committee's adopted pure premium benchmark rate of $2.38 is roughly another $2 billion.
That's correct.
Okay, so then if I could go back to Mr. Mudge then. So with regard to the two bases for the governing committee's governing committee majority's decision, you said one of those was what happened last time with the reforms. Has there been any quantification with regard to the difference in savings that were projected by actuaries with regard to the 2002-2004 reforms and the savings that actually resulted from those reforms? And what's the absolute dollar figure on those savings?
I'll have Dave answer that question as well, but I can tell you that another way of looking at this issue of what level of savings has to occur for the $2.38 benchmark to hold would be about a 40% reduction in the increase in cost we've seen since the reforms were fully implemented on that chart I showed from 2005 to today. If we're able to, with the reforms of SB 863, tilt that down and reduce 40% of that increase over this period of time, then that's another way of showing that the $2.38 number could hold. And I believe we put that in materials we provided to you, but I'll have Dave answer.
Well, actually, before we go to Mr. Bellucci, I mean, the 2002-2004 reforms, though, are different, Mr. Mudge, than the reforms in 863, correct?
I don't think there's a question that the scope and magnitude of the prior reforms were much larger than they are within 863. That's correct.
Okay, and then on the second point you made about why the governing committee majority came out the way they did, you talked about uncertainty associated with all of the regulations that are in process now. But isn't it the case that all of SB 863 or most of SB 863 requires regulations that are in process right now?
I think actually a number of the areas we looked at did not have, the things that we quantified did not have speculation about what regulations would be. We were fairly clear about what at least the intent of the regulations were, specifically around things like spinal implant hardware and those types of things. I will say the biggest area that we had not evaluated, and the governing committee is aware of this, we just felt that there was not a way for us to do that at this point in time, is as I mentioned, the impact of medical as a result of the IMR process that is now included within SB 863.
But estimates of the savings associated with that were a part of the actuarially indicated rate coming out of the actuarial committee's recommendation, or actual committee's work, were they not?
I'll have Dave clarify what pieces they are, but they were not encompassing the medical treatment component potential effect as a result of IMR.
Okay.
And we think that potentially is the largest piece of IMR, but remains to be seen.
So let me maybe address a couple of the questions that were with respect to the evaluation of the 2002 through 2004 reforms, which, as you pointed out, Commissioner, were very different. And I don't think Mr. Mudge mentioned, I don't think anybody's suggesting that SB 863 has anything close to the kind of scope that we saw in 2002 2004. But that said, ultimately, and we put a monitoring process in place as we're suggesting for SB 863, and we regularly monitor it. Our most current estimate was that basically a 2/3 cost reduction, saving something like $14 billion a year retrospectively. I don't precisely remember the estimate. We certainly have it, the initial estimate. It's in our latest cost monitoring report. I just don't have it with me. But my sense of it was probably less than $5 billion in terms of estimated savings, and we can confirm that and get that information to you on that question. With respect to the question on independent medical review, which was reflected in the actuarial committee, and we looked at a number of components. There were the frictional cost impact, essentially replacing higher cost liens, which are very costly to process, and medical legal reports, QME qualified medical evaluator reports that again are very costly, and then an expedited hearing process to resolve medical treatment disputes. We looked at replacing those costs with a much lower cost independent medical review. That was one of the things we priced. We also, as I had mentioned earlier in my comments, in response to an earlier question, we also looked at the impact of independent medical review on temporary disability duration. We priced that. We also looked at sort of the indirect impact of independent medical review on litigation, and there was a price component built in the actuarial committee estimate for that. As Mr. Mudge mentioned, the one area that there was really no consensus about on what the impact will be, and it was on medical treatment, which potentially is very significant. As we know, workers' comp is in large part a medical benefit delivery system, and that's where the dollars are. But ultimately, there was really even no consensus on what the impact would be, given uncertainty into the regulations, potential legal challenges, how they're interpreted and implemented, and how medical treatment practices evolve, given that you have independent medical review. There really wasn't, the actuarial committee felt there was no basis to estimate a savings on medical treatment costs from independent medical review.
Due to the level of uncertainty.
Due to the level of uncertainty, yes.
Okay. Then, Mr. Mudge, if I can go back then to the actual process the governing committee used to make this decision. I have to say I'm not persuaded by the comparison to the 2002-2004 reforms, because those were so different in kind and in magnitude. But I understand from your testimony and Mr. Bellucci's testimony with regard to the second basis, the uncertainty associated with medical treatment. But I want to drill down a little bit more on how the governing committee went about making this decision, and were there any studies consulted by the governing committee other than the report that came to them from the staff of the WCIRB with the actuarial committee's work? Were there any other studies handed out at the governing committee meeting that they consulted in this deliberation?
Right. There were no other studies handed out at the meeting. There was reference to the work done by Mark Priven at Bickmore Risk Services on behalf of the public members of the governing committee. And there was some discussion about the range that Mr. Priven had in his analysis, and some alluded to that his analysis certainly had a range that was lower than our best estimate of $2.60 at the time. There was no handout of materials, but there was a brief discussion about that the committee was certainly aware of.
But let me just continue with Mr. Mudge, if I could, before we go to Mr. Bellucci. But there wasn't any other than actuarial study, hard copy, written actuarial study or analysis in front of the committee, other than what had been done by staff and the actuarial committee at the time this decision was made.
That's correct.
And then, were there any
That's correct.
other hard copy reports consulted by the governing committee when it made this decision? Were there, I mentioned studies, but any other reports other than what was coming up from staff that was available to them at that time that they consulted?
Well, I don't know what would have been available to each of them as individuals before they walked in.
But handed out
the
at the
room,
meeting?
but no, not handed out, right?
Yeah, there was some discussion about some of the results of Texas. I believe that the Texas experience, who did have an IMR process back and went to an IMR process and did publish a report that indicated savings coming from all their medical reforms, including IMR. So there was some discussion of that, but I don't believe any of that was handed out at the meeting.
Not an actual report.
No, there was
Okay.
no report handed out.
And then, so then, was there any other written analysis in front of the governing committee members other than what had been provided as a result of the staff taking the actuarial committee's work and making its recommendation to the committee? Any other written analysis at all?
The only written analysis I'm aware of that was provided to them in the committee came from us. So all of our work product that you're aware of.
And then, in the course of their deliberations, did the governing committee revisit any of the principal assumptions made by the actuarial committee or the staff with regard to the actuarially indicated pure premium benchmark rate?
Well, there was certainly discussion, and I'll let Dave jump in here as well, Commissioner. There was certainly discussion about, you know, the potential magnitude of the savings from these reforms. We're speaking about how the actuarial committee and staff came to their conclusions. What was the possibility or the range of potential that one could see from savings? So there was a lot of discussion about, along the lines of, as you've been asking us, how did the actuarial committee do its work? How did they come to consensus on things? What did that mean? We provided detailed by line item numbers relative to the aggregate of the reform benefit that Dave has alluded to or mentioned to you earlier. So yeah, there was a lot of discussion about that. I'm not going to say that the people that are sitting on our governing committee are actuaries who are going to get into an actuarial derivation discussion, but there certainly are long-standing professionals who have experienced things in this industry, and they asked, I think, good questions of our actuaries.
So, but other than the uncertainty associated with medical treatment cost savings, were any of the underlying assumptions that underlay the actuarially indicated pure premium rate, were any of those criticized? Were any of those determined by the governing committee to be incorrect? Was there any delving into any of the assumptions that underlay the actuarial committee's indicated rate, other than the uncertainty about medical treatment?
Well, I think there was an awareness that there's uncertainty around all of the elements in terms of where judgment was made by the actuarial committee. Good actuarially sound judgment, but there's certainly a range of perspective around a number of those. Each item was presented, each item was discussed.
Were any of them rejected by the governing committee?
None were rejected, no.
Okay. And then the other question I have then is the $2 billion or so of additional savings that the governing committee in its pure premium recommended rate is assuming will occur on top of the savings that the actuarial committee assumed could be derived on net from SB 863. How was that figure arrived at, that additional $2 billion in savings? Was there any math done by the governing committee members in the course of that deliberation?
I think there was a question, and I'll let Dave jump in because I think he was asked the question. There was question of how much additional savings would it take if we were to, go down the course of path that they ultimately did. And I think Dave provided perspective, and I'll let him speak for himself here, provided perspective to the committee on the magnitude of what that would mean, similar to what he has said to you today.
But I guess what I'm because you were present in the meeting as well, what I'm trying to understand is, was there analysis and math done to reach a conclusion that there would be $2 billion in additional savings, therefore the rate ought to be 238, or did the governing committee just conclude that the rate ought to be 238 and the savings is indicated, if you will, as a result of deciding that the rate ought to be 238?
I think the decision was more along the lines of, given the range of uncertainty around the potential savings from these reforms and on top of the areas that have yet to be quantified, that ultimately the majority of the committee made a decision to not adjust the claims cost benchmark. There was not a math discussion about if it was this or that, what would that mean in terms of the number. I think it was more along the lines of what I just said.
All right, and then at the time the committee made that decision, which was in early October, I believe, September 26th. Thank you. Did the committee have in front of it the current average industry filed pure premium rates? Or asked a different way, when the committee decided to stick with well, as you just said a moment ago, the committee decided to stick with the $2.38 previously adopted pure premium rate. What industry average filed rates did the committee have in front of it when it made that decision?
That number.
That number. Okay. But that number was, I think as you explained in your presentation, only good as of June 30th. I mean, that number reflects the industry average filed pure premium rates as of June 30th, 2012, correct?
7/1, yes.
7/1, I'm sorry, July 1st, 2012.
Yes.
Okay. So the meeting is in September, but what the committee has in front of it is the industry average filed pure premium rate as of July 1st. I think you testified a moment ago, though, that if one were to actually update that information, the actual industry average pure premium filed rate as of today is $2.49. Is that correct?
Actually, the number of $2.49 is not a calculation done by us. It was provided to us as a, I believe, my words, early indication of filings that the department has received from a limited set of carriers for 1/1/13, and the department actually did that calculation and provided it to us.
Let me ask Mr. Belushi then, with regard to that figure, do you have any reason to disagree that the industry average filed pure premium rate based on filings up to November 1st is $2.49?
As Mr. Mudge mentioned, I think it's a preliminary estimate, as many insurers have not yet submitted their filing, but it, in my mind, I have no reason to believe it's not an accurate reflection of the average pure premium rates that were filed as of this date, but could well change depending on additional filings that are received between now and 1/1.
But it's certainly less preliminary than the industry average filed pure premium rate as of July 1st, 2012, which is what the governing committee had in front of it, right? I mean, that's a preliminary number too. That's even more preliminary because that only has 6 months worth of industry average filings. This number, if you don't dispute the number, is updated to include another 3 or 4 months or so of industry filings, right?
Yes, I think it does reflect additional information beyond the 238, and as I said, it certainly is a preliminary indication of where the 1/1/2013 average industry filed rate will likely be.
Is it better information with regard to where that might be than the information as of July 1st, 2012?
Yes, I would say in that it's, despite the fact it's preliminary, it is more current and does reflect additional information that wasn't reflected in 238. So yes,
okay. And yet the board didn't have that information. The governing committee did not have that information in front of it.
They did not.
Okay. And then finally, Mr. Mudge, you've indicated, or Mr. Belushi indicated, that the actuarial committee in reaching its conclusions with regard to the costs and savings and net savings associated with SB 863, coupled with whatever else is going in the workers' compensation system, spent roughly 3 months working on its analysis. Can you tell me, how long did the governing committee deliberate on the pure premium benchmark rate that it adopted and is recommended to me as a commissioner?
Well,
how long did deliberation in that meeting on that day go on this particular item? 5 hours, 6 hours, 8 hours?
no. I would say that the basis for their knowledge set
let me
about,
just be really clear. The actual
Sure.
time that they spent in that meeting,
I would say
deliberating.
probably between 30 minutes and an hour on the debate of the discussion. Prior to that, there were probably at least a good hour or more of presentation by staff on the material, and they all had that material at least a week ahead of time, and many of them, several of them I believe, were also intimately involved in the evaluations and discussions of the legislation as it was evolving.
Fair enough.
Yeah.
So they had 3 months worth of work, and they deliberated about it for about 45 minutes.
I can't give you an exact time, but I'd say under an hour.
Under now. Okay, very good. I really appreciate your responsiveness to my questions, both you gentlemen. And I know Mr. Belushi wanted to present some more information to us, so we'd be happy to receive that at this time. But thank you very, very much.
Okay,
Most
great.
appreciated.
And some of the discussion we just had will, touches on what I did. So in some of those I'll go try to speed it up a bit if we've really talked about it. So really quickly, quick summary of SB 863. We talked about it already, but I did want to kind of highlight some of the differences. That the principal part we've talked about, where there were benefit changes effective both January 1, 2013 and January 1, 2014. Those changes, as I mentioned, will impact costs really without the need for implementation regulations or judicial interpretation. They can be evaluated on a standard, relatively straightforward basis. Other of the reforms, some of which we've already talked about, were quantified based on the data that was available and in many cases judgmental assumptions. Other provisions, and I think these are important to talk about, are not quantifiable at this time. They depend on future regulations. Some of those have the potential to significantly impact costs. There's a return to work program that's really outside the pure premium process, so that's not any cost coming from that is not reflected in this. There are new medical fee schedules for home health, for interpreters, for copy services that remain to be adopted. The hope and intent is probably to reduce medical costs with those new fee schedules. However, we can't value them until such time as we know the values, until the values are adopted, and the legislation requires those schedules to be adopted sometime during 2013 or later. And lastly, we talked about independent medical review and the issues around that. I think we really talked about already sort of the process we went to value the legislation, so I'll skip over those. Here's a summary of the evaluation that came out of the actuarial committee. And it summarizes the 4.4 that I alluded to earlier in response to a question. This summarizes each of the pieces of the reforms that we valued. And in total, there's about, if you look at the 2013 and the 2014 pieces, there's about $1.2 billion in savings. That's offset, I guess it's closer to 1.6, not the 1.7 I mentioned, in terms of reforms coming in. The net impact of it that reflects that not all the 2014 benefit increases impact 2013 policies, but the net impact on 2013 policies is 4.4%. So let me move, since I think we talked about those, let me just kind of put a little context around it. And really in terms of some of the key cost drivers that we're alluding to, that differentiation in claim cost trend with kind of economic growth that Mr. Mudge alluded to. So this looks at loss adjustment expense. Many of the provisions of SB 863 were directed at frictional costs. That's been one of the most rapidly growing cost components in the system, as highlighted here. In 2005, we estimated a little less than $6,000 of allocated loss adjustment expense per indemnity claim. By policy year 2013, we're projecting that's grown more than doubled to almost $14,000. Well, in our original filing submission made in August, we cited several reasons for that deterioration. First and foremost was the sharp growth in liens. SB 863 introduced a number of provisions related to liens, including a filing fee, an activation fee, a statute of limitations. We did reflect in our estimate that there should be a significantly reduced volume of liens filed. In addition, the IMR process should also reduce liens. Another area we cited were the 2009 WCIRB decisions on Ogilvy and Almaris-Guzman, which we've talked about in prior hearings at some length, and they impact the permanent disability ratings that are produced for injured workers. SB 863, by eliminating the future earning capacity component in the computation of permanent disability benefits, effectively eliminates the impact of Ogilvy. However, SB 863 really doesn't do anything to address Almaris-Guzman directly. Another issue we've talked about that driving costs in prior hearings is the medical cost containment area. SB 860 doesn't directly address it, but it's hoped that the new independent medical review and the independent bill review process will reduce some of these frictional costs related to medical. Lastly, we have indicated in the past that increasing volume of claims over the last couple of years, particularly with respect to claims involving cumulative injuries and claims that involve multiple body parts, have been driving loss adjustment expense cost. And these areas were not addressed by SB 863. So in total, a number of the key components leading to the increase in frictional costs were addressed by SB 863, but others were not. Our estimated 863 impact that we provided in the filing materials estimates about a 20% reduction, shown on this slide, in allocated loss adjustment expense costs per indemnity claim. This reduces the policy year 2013 from about $14,000 to $11,000. Now, assuming that the additional SB 863 savings that we talked about earlier that were necessary to produce a pure premium rate equal to that $238 that we discussed would apply proportionately to loss and loss adjustment expense, we would need another $1,000 reduction in loss adjustment expense coming from the reforms to produce the kinds of savings that are reflected in the pure premium rates. Going for a similar process for medical, we projected that medical cost per indemnity claim will increase by almost 80% from accident year 2005, that was when the reforms of 2002 and 2004 were fully implemented, to our policy year projection for 2013 prior to SB 863. And as with ALA, we cited a number of factors driving that. First is the cost of medical treatment. As shown in this slide, there were a number of provisions of SB 863 that potentially address medical treatment costs. Some of them these were able to quantify, others were not quantifiable, in that they depend fully on future regulation, or there was really no statistical basis to develop an estimate. Rapidly growing lien costs are also driving the increase in medical costs per claim. And as discussed a minute ago, SB 863 did make a number of changes in there intended to reduce the cost of liens. Rising medical legal costs have also driven medical costs. The SB 863 provisions related to independent medical review should curtail some of these. Finally, we also cited pharmaceuticals and Medicare set-asides as driving increasing medical costs, and these were areas that weren't addressed by SB 863. So as with allocated loss adjustment expense, a number of the driving components of medical cost inflation were addressed by SB 863 and others were not. Our estimate that's reflected in the 261 average pure premium rate reflected about a 5% reduction in projected medical costs due to the provisions of SB 863 that we were able to quantify. In order to produce the level of savings as reflected in the 238, we would have needed another 8%, or basically another $4,500 or so in savings. Lastly, I did want to, and we did talk about this at some length, so I'll go through this quickly. I did want to kind of highlight some of the uncertainties and risks involved in this. Again, this is a very atypical filing. Whenever you have key changes to the benefit delivery system, they're challenging to evaluate, and there's a wide range of uncertainty. So some of the key things that haven't been evaluated yet As I mentioned, or as I earlier mentioned, fee schedules for copy services, home health, and interpreters, those may produce additional savings once they're adopted. Ultimately, there's potential savings coming from the conversion of the official medical fee schedule in California to a Medicare type-based and RVS basis. That's a 4-year process, so those savings, are somewhat down the road. They materialize. Some of the risks, we've identified a number here. Some of the key components of SB 8633 are potentially subject to legal challenges, and the success of those challenges could have a big impact on the savings that materialize. Lastly, again, we discussed so much of workers' comp is involved in medical treatment costs. To the extent independent medical review and others impact medical treatment, there are potentially significant cost impact depending on what those impacts are. And those we won't know for some time. Well, given all these uncertainties, risks, and potential unintended consequences that come with any change of this magnitude, we believe it's critical to be very proactive in measuring those costs, specifically as we see them and as they begin to reflect themselves in emerging information. We've already met a few weeks ago with our claims working group, which is that very broad group of researchers, claims people, legal experts, actuaries, to build a plan to say this is what we're going to look for to try to measure some of these key costs. You get some quick hits on what's happening in medical treatment area, for example. So we've started to put that plan together. We plan to submit it to you sometime in the first quarter. So it's basically what we wanted to present, available to answer any questions you may have.
So I've asked a lot of questions. Let me see if Mr. Dahlquist or Mr. Sitko have some questions. Thank you, Mr. Belushi.
I really don't know that I have much to add at this point. I guess just one question to clarify. In discussing with the in the governing committee meeting, there was mention that possibly ranges or possible ranges of outcomes were discussed. Did the actuarial staff actually present anything with regards to a range of reasonable estimates around the $2.61 number?
There was quite a bit of discussion at the governing committee about sort of the uncertainties and that there is a wide range, but I don't recall that we provided any specific high and low estimate around the best estimate of the 261.
I think I need to ask one question though, with regards to the $2.38. Well, first, what is your, in your professional opinion, what is the most likely occurrence here? And secondly, what's your professional opinion as to the likelihood that lost costs will actually reach $2.38?
Well, let me try to characterize that. I think the $2.61 was the best estimate of the actuarial committee through a consensus, and I concur. Personally, professionally, I think that's a good, reasonable estimate, and see no reason to deviate. That said, there is a wide range of, as you know, there's a wide range of reasonableness around that estimate. It is possible that we could have overstated some of the savings. Some of the legal challenges are successful. Some of the regulations aren't implemented effectively. There's some unintended consequences that we didn't see. So I don't want to give the impression that it's a one-way range of reasonableness. That 261 in my mind is the best estimate, and I professionally believe that. While there's always a range of reasonableness, I think there's a particularly wide range of reasonableness when you have system changes of this magnitude and all the uncertainties that we've talked about. In my mind, 238 probably falls within that range of reasonableness. There's some likelihood that it be achieved. But again, I think there's also some likelihood that even the savings we've estimated, doesn't materialize.
All right, thanks. With regards to the subject of the IMR, I know in the committee discussions, one of the products of the committee discussions was a decision to proceed with a study on the subject. Can you inform us as to the status and the timetable of that study and what it's intended to achieve?
Yeah, and it's evolving a little bit. There was some discussion at the last claims working group on how to kind of attack this question. And just to take a step back, I think the question Mr. Dahlquist is alluding to is what we discussed earlier, trying to get an early measure on what the impact of the new IMR process will be on medical costs. Medical treatment costs specifically is the area where there was maybe the greatest uncertainty and the greatest discussion about what that impact would be. So what we're envisioning is really a three-prong attack at it. First, to get a sense on what's happening in the medical treatment dispute too. There are two pieces to that. We envision doing a survey of insurers as to resolution issues on expedited hearings, taking a random sample of hearings that go to the WCIRB on medical treatment disputes and getting a sense on how those were resolved. Was the treatment provided? Was it not? To get a sense of the current system. Secondly, we've had some discussions with CWCI, California Workers' Comp Institute, on using some of their transactional medical database to follow the history of utilization decisions, medical treatment utilization decisions, and find out how often were those overturned, or how often was the 6 months down the road or a year down the road was the medical treatment provided. Now that's two prongs of the estimate, trying to get a sense on the current system and really get a better handle on the costs involved in the medical treatment dispute under the current system. Alternatively, we want to see what's going to happen under independent medical review, and there are a number of things bounced around. And where we ended up is, given that we're 45 days or something away from independent medical review being the law of the land in workers' comp, is to work closely with the initial firm that likely will be doing the independent medical review, as well as the Division of Workers' Comp, on getting the results, getting information from actual medical disputes that go through the IMR process. And we've just started that process. We've had some discussion with Director Baker, who's helping develop the regs, on what information will be provided from the independent medical review company, as well as that independent medical review company, in getting a sense on what's available. The time frames we're still working through. We hope to have some information by the first quarter on those pieces, and ultimately we'll update it as time goes by.
All right, thank you. I had just one final question for you, and we haven't really, we've appropriately been concentrating mainly on the impacts of SB 863, but getting back to just the basic experience analysis that preceded that. One of the main concerns, as I see it, is that there's been adverse development. In other words, the accident year loss ratios that the Bureau has estimated have increased fairly consistently over recent successive evaluations. To what extent is that a concern of yours, and what has the Bureau done to deal with that, and how does it impact your view of the possible, I want to say the possibility of experience possibly turning out to be worse than expected?
Yeah, a good question. Well, first, we have seen steady deterioration. Now, some of it's due to some refinements in the methodology, but even controlling for the methodology, we've seen steady deterioration from quarter to quarter in our projections of ultimate. Basically, as as a result of payment patterns continuing to slow. So it is a concern. We've done a lot of work in that area. We plan to continue it. But on top of it, we sort of have a new interlay, because one of the byproducts of SB 863, if it works as intended, is to speed things up. So one of our first challenges, and we plan to also look at that in the first quarter, is try to intermix the impacts of SB 863 with those loss development projections. Because as you know, not only many of those provisions, at least we believe at this time, though there may be some question, many of those provisions of SB 863, like liens, provisions related to liens or independent medical review, apply on a date of service basis. And so that means there'll be an impact not only on future injuries, but also impact the loss development of older years. And with the idea that some of that deterioration, this improvement in speeding up of the claims process could reduce that. So our first challenge that we plan to look at in the context of when we look, or in the first quarter, in the context of when we look at a potential July 1 filing, is to kind of analyze that interaction and see how SB 863 interplays with the normal loss development patterns we have. And so it is something that we plan to give a lot of attention to in the next few months.
Okay, thank you. I don't have any further questions.
Okay. Well, we've been at it for some time, and Mr. Mudge and Mr. Bellucci have been on their feet for some time. So why don't we take a little break, and then what we'll do, we'll reconvene, say, in 15 minutes. And where are the restrooms in this facility? Out the hall. Just,
right.
Great, so everyone knows but me. But I wanted to make sure you knew. It was kind of a test. So we'll take a 15-minute break, which means we'll reconvene at 11:20, and we'll have a chance then to hear from the public members of the WCIRB Governing Committee, and then the rest of the public as well. So we'll take a recess at this point. Thank you very much.
All right, let's reconvene. It's 20 minutes after the hour. I do want to remind everyone that we have sign-in sheets out in the foyer. That's for two reasons. One, if you would like us to provide you with a copy of the commissioner's decision, we have your name, address, and email. We do like email, it saves trees. The other part of this sign-in is that if you would like to speak, please make sure to mark that on that sheet, and we'll have our staff let me know who wishes to speak based on the sign-in sheet. And with that, I think we will proceed.
So I believe next we will hear from the public members of the WCIRB Governing Committee. And then, just so folks know what the rest of the choreography is going to be, then we'll have a chance to hear from, I believe, the Governing Committee members' actuary as well. And so, why don't we go to the public members? Welcome.
Thank you. Thank you, Commissioner Jones, Mr. Dahlquist, and Mr. Sitko. I'm Mark Priven. I'm an actuary with Bickmore. I sit on the actuarial, the Rating Bureau WCIRB Actuarial Committee. Just to clarify, I'm not part of the Governing Committee. I represent the public members of the Governing Committee on the Actuarial Committee.
Just so we know where we're going. So will the public members be testifying too, or?
Yes, those that are here. 3 of the 4 are here.
So the plan is you'll go first and then they'll go.
Correct.
Or however you want to do it. Okay.
That's the plan. I'll
That's
go
the
first,
plan.
then
All right. I see thumbs up from the public members. Great. Okay. You're on.
As you know, I've submitted written testimony to the department prior to this testimony, to this oral testimony. 2 sets. One regarding a general commentary on the rates, and one specifically on the impact of the reforms of SB 863. So I don't have a lot of new things to say. I'm just going to sort of summarize what's in that written testimony quickly and then be available for questions and comments. Overall, I would characterize that my middle projections, I give a range of projections, a reasonable range from low, middle, and high. My middle projections are fairly close to those that were recommended by the Rating Bureau Actuarial Committee. Excluding the reforms, I think that the rates are going to be, or that the rates would have been a little bit higher than what the Rating Bureau actuaries said. Primarily, I have a difference of opinion regarding how losses are trended and also some of the methods used to develop the losses to ultimate. On the other hand, counterbalancing that, I believe that there will be greater savings from the reforms than was decided on or agreed to in the Rating Bureau Actuarial Committee. And so the net is that the middle of my range is very close to what was recommended by the Rating Bureau Actuarial Committee. The reason that I believe that the reforms will result in greater savings than what the Rating Bureau Actuarial Committee recommended is two things. A smaller part is regarding utilization related to the permanent disability increases. That's a small part, but a much greater part is the impact of independent medical review, IMR, which has already been talked about earlier. Specifically, where I differ is the impact on IMR on temporary disability and on medical costs. So when we at the Actuarial Committee talked about the impact of IMR on temporary disability, we talked about a few different factors. One is that temporary disability duration has increased over the last 5 years or so since the prior set of major reforms, and also that California's duration of temporary disability is greater than that of Texas, which has an IMR, and many other states. And those were sort of used as the benchmark for how much to reduce temporary disability duration for independent medical review. I will add that I also looked at specifically what happened in Texas when IMR was implemented. And I want to caveat this by saying I know California is not Texas. The systems are different. They were different when IMR.
And thank goodness for that.
Yeah. Okay. Though on workers' compensation, I have to say, for example, their results from IMR, if we could replicate those, we would do well. What I saw on temporary disability is that the 2 years prior to the implementation of IMR, temporary disability was increasing at about 12% per year for those 2 years. And then after IMR, it decreased at about 8% per year for 2 years. That's about a 20-point swing per year for 2 years. Now, I also want to caveat and say that when Texas implemented IMR, they also implemented other provisions as well. So I'm not saying that this was all due to IMR. But there were several, when these reforms happened in the early 2000s, I believe they were passed in 2001, late 2001, and implemented in 2002. Medical treatment sped up, medical payments sped up, temporary disability decreased, return to work increased, and so there was, and also medical disputes. There were more medical disputes that resulted in denials, which you would expect from IMR. So based on that big change in Texas, as well as the deterioration of temporary disability benefits or duration in California, as well as the fact that TD duration in California is much higher than in Texas and other states, that I use that as a basis for decreasing expected TD duration a little bit more than the Rating Bureau actuaries did. Now, let's look at medical. You've already heard today that that the Rating Bureau actuaries did not feel comfortable evaluating the potential impact that IMR would have on medical costs. The way I look at it, what's been happening with medical is analogous to what's been happening with temporary disability. Specifically, as was shown earlier, medical costs, just like temporary disability duration, has deteriorated very substantially in the last 5 to 7 years since the prior set of major reforms. Medical costs in California are much higher than those in Texas and in other states. And lastly, if you look specifically at Texas, when IMR was implemented, it's almost the same result. The 2 years prior to IMR, medical costs were increasing at about 12% per year. And in the 2 years after IMR was implemented, medical costs decreased at about 8% per year. So again, it's a 20% annual swing for 2 years. Now, my projections don't assume anything close to 20% savings or even 40% savings, which you could, potentially talk about if you have two years in a row of 20% savings. But I did think that based on that, it's fair to assume that there will be some decrease in medical costs with the implementation of IMR in California. Okay, so that covers what I wanted to talk about in terms of why my estimates are different, or how they're similar and how they're different than those of the Rating Bureau. I also want to talk a little bit about the range of estimates, because you've asked a lot of questions about that, and I just wanted to give you my perspective. First of all, I was not at the governing committee meeting at the time. So if you have questions about what actually occurred there, I'll defer to the public, to the governing committee public members who will testify after me. First of all, I want to stress that what I gave is a range of indications, and I believe that everything in that range is reasonable. It's a reasonable range, and it's based on information and data, okay? It's not just that the middle of the range is the only reasonable estimate. The entire, the range itself is reasonable, okay? In addition, Mr. Mudge mentioned earlier that one of the topics of conversation was what happened with the prior set of reforms, and I realize, Commissioner, you didn't find that particularly valid or persuasive, but I just want to point out that with the prior set of reforms, the Rating Bureau was slow to decrease the rates in relation to how fast the costs actually decreased. And partly as a function of that, insurance companies were slow to decrease their premiums in relation to their costs, to the point where in 2005, over 40 cents on every dollar of premium was actually profit for insurance companies. So I just want to repeat that. In 2005, for every dollar of premium, over 40 cents was profit. So I'm quite sure that the representatives of labor and business who worked so hard on these reforms wanted, one, for injured workers to get better benefits and better medical care, and two, for there to be relief in the cost to the employers. They were not particularly interested in boosting up the profits of insurance companies. And I'm sure that weighed on their minds as they were thinking through what appropriate benchmark would be for the Rating Bureau. In addition, the members of the governing committee, the public members of the governing committee did have my study, which showed a range, which was an independent analysis on which to base their analysis. And I'll also mention that the state fund who was there is, obviously the largest insurer in California. If anybody has the ability to do their own independent study based on their own data of what would happen with the reforms, if any insurer has that ability, it would be the state fund. And the information that was out at the time was that they saw much greater savings, specifically from liens, I believe. And you can even go on their website and see that they're talking about decreasing rates by 7% as a result of these reforms. So we're not talking about just keeping rates the same, which was what was voted on in the governing committee. The largest insurer is actually talking about decreasing rates by 7%. I also want to mention, and this was discussed a little bit, that there are many areas of the reforms that were not able to be quantified. In my opinion, those areas are much more likely to decrease cost than to increase cost. We talked about medical care for IMR, but another big one that has not been mentioned today is independent bill review, which we refer to as IBR. I talked to many employers who are very excited about IBR and potential savings from IBR. And again, that's another issue that was not quantified, that was not able to be quantified by myself or by the Rating Bureau in general in terms of the savings. But I do believe that, if anything, that will result in savings as opposed to additional costs. That's all I want to say about the range. I just have two more small points I just want to bring up and then open up for questions. One is, I just want to go on record in recognizing that these reforms have produced somewhat of a windfall for insurers. By that I mean, all we're talking about right now is rates for prospective policies, but we're not talking at all about the retroactive impact of the retrospective impact of the reforms. The costs that will increase as a result of the reforms, for the most part, are only related to injuries which will occur after January 1st, 2013. That's when the new permanent disability cost schedules kick in. On the other hand, some of the savings, specifically related to liens and related to IMR, once they're implemented, will affect open claims. And so we haven't talked about repricing old, existing policies or anything like that, but I think it needs to go on the record that insurance companies are receiving a benefit, and self-insured employers and employers in large deductible programs are receiving a benefit from this reform that goes beyond just the future cost of future policies. The last thing I want to mention is that I believe that this reform will also help to reduce not only the cost next year and the year after, but should also slow the rate of inflation of workers' compensation in the future, because the areas of the workers' comp system that have been inflating quite quickly, specifically loss adjustment expense, medical, and other expenses, are decreased as a result of the reforms, whereas the area of workers' comp that tends to inflate at a lower rate is indemnity, and that area has been increased. So the whole pie, if you think about how the rate at which the entire pie grows, it should grow at a lower rate because of that factor. That's all I have for my prepared remarks. If you have any questions.
Let me start with some, and then let me go to Mr. Dahlquist.
Sure.
First, I appreciate your presentation. We have your written materials. If you've got any slides, we can throw those up too. But
I didn't bring any.
Okay,
no.
very good. So I was struck by a number of things that you said. You mentioned that state fund was at the governing committee, but again, let me just pose the same question to you that I posed to Mr. Mudge and Mr. Bellucci. Did state fund provide any written analysis to the governing committee members in their deliberation with regard to the pure premium rate filing?
I wasn't there, so you'll have to.
Okay, but you're not asserting that they did, right?
No.
All right. You have no information contrary to what Mr. Mudge and Mr. Bellucci said, which was that there was no other written report, analysis, or anything other in writing provided to committee members other than what the actuarial committee provided. You're not asserting that there was some other information in writing given to them, are you? Okay. Then I take your point with regard to returns associated with 2002-2004 reforms. The only thing I would note is, I've said publicly, and I've said to the stakeholders that were involved in this set of reforms, that perhaps the best way that they could avoid that sort of outcome again would be to include language in SB 863 or whatever set of reforms is done, which would essentially work to make sure that there wasn't a windfall associated with some level of cost savings beyond that which was projected. And for whatever reason, no one seemed to advocate for that. But I mean, is it your position that I'm allowed to consider the question of whether there might be excessive returns in the context of deciding what the pure premium rate benchmark should be?
I'm trying to provide a context within which I think some of the decision makers were voting.
Okay, that's fair. But I just want to point out, I'm governed by a body of law that says that I have to do this process and cabins what the process is. And I might wish that it were different, that I could take other things into consideration, but the law tells me what I have to look at for purposes of making this advisory opinion. So I appreciate your point, and I appreciate you weren't arguing that I can take into consideration that issue of potential windfall in the context of setting pure premium.
When I mentioned windfall, I was talking about the impact of the reform on claims which have already occurred. I'm not sure if you're talking about the prior set of reforms and the profit that was made from those as a windfall.
Well, I
or are
think
you
I'm
talking about the
I'm talking about
retrospective?
both, actually.
Talking about both.
Yeah.
Well, the former, in terms of the profit from the prior set of reforms, I think that's just context, in terms of what people are thinking about when they're looking at what a reasonable rate is and how to treat a range. When you have a reasonable range in front of you, how do you consider where in that range you want to be? You'd look at some prior experience and say, well, what happened last time? Okay, I'm just trying to give some context on that.
Sure.
In terms of the retrospective impact, yeah, no, I don't think that's not, I wasn't bringing that up in the context of what a prospective rate should be.
Okay. And as we sit here right now, what are the combined ratios in the industry?
I don't know exactly, but in the 130s, is that right?
Our latest estimate the last 3 years at
138.
Okay, and so the import of that is that for every dollar of premium being pulled in,
Right.
the carriers are paying out $1.38.
Correct.
Okay. All right, I don't have any other questions. I appreciate your testimony. Thank
Sure.
you.
Could I just,
Sure.
before you start on that, let me just, there are a couple of items with what you said. When you talk about a range, there's probability of what may occur within that range. And does your analysis include that?
No, I didn't assign specific probabilities to them. What I did is I looked at reasonable methods, reasonable assumptions, and whatever came out of those sort of defined the reasonable range. But it wasn't like a statistical analysis of, 10% chance it could be at the bottom of the range, 10% chance at the top of the range, anything like that.
But yet there's some probability that would be attached to those items that you've noted in your analysis, that whether they would occur within that range based on some of the factors that the Rating Bureau brought up, such as litigation. Is that correct?
I'm sure there is a probability, but I didn't calculate it.
Okay. The other thing is you did point out the prior reforms and the fact that the Rating Bureau's estimates were short of what the actual reduction in costs were from the prior reforms. But as I recall from the prior reforms, there were some studies, for example, on permanent disability, and some of them were roughly close to what the savings was going to be.
Right, like Dr. Brigham, is that what you're referring to?
Yeah,
Brigham, sorry.
yeah, the Brigham
I believe
study.
Brigham's, yeah.
Do we have anything similar to that presently that we can draw upon for, other than the Texas example that you've cited?
Right. I think looking at, and I believe Texas is really the best example in terms of what would, if you want a case study of what could possibly happen in California. I haven't found any other states that would be a better example. So you could certainly look at Texas, and in addition, I believe the state fund would probably provide you with some information on liens that might not be the same as what myself or the Rating Bureau or the CWCI say.
Yeah, but we don't have the information from state fund or from anybody else on liens at this point in time.
Okay.
Okay. All right. Well, I didn't know because you were saying that I didn't know if there's some data out there or some study that was being done by state fund that you may be aware of.
No.
Okay. All right. Well, thank you.
Okay. I'd like to start with your evaluation of the basic experience.
Okay.
Without getting into extreme detail, but I would like to, get some explanation on that. I'm talking about the basic experience analysis that determines the pure premium rate need, absent the impacts of SB 863. Am I correct in reading your report that your low estimate is the same as the Bureau actuarial staff estimate
For loss, correct.
for loss?
Correct.
Loss adjustment expense, I understand it's slightly different.
Correct.
I don't know that we need to get into that. Can you briefly summarize why your middle estimate is different? Just briefly, what are the major differences?
Sure. As I mentioned, there's two main components. One is the method that was used, or that's used to calculate ultimate losses for prior years. So the projections for the future are based on two things. One, the projection of ultimate loss for the prior years, and then two, what we call trend, which is the adjustment of how the older years are adjusted for inflation and other factors to how they might portend for the future year. So both of those factors are different in my middle projection. Regarding the projection of ultimate loss for the older years, the Rating Bureau projections are based strictly on paid losses developed to ultimate. What I was looking at is that, I think this was alluded to earlier today, and you brought it up, that the ultimate loss projections using the paid method have deteriorated over time. Every time we get more data, we look back at those older years and we realize that they're actually worse than we thought they were, or the costs are higher than we thought they were. And so I looked at some of the other methods that were calculated and provided by the Rating Bureau, and I looked at specifically the incurred loss development method, and it seemed to me that those loss projections have been a lot more steady, that they haven't deteriorated in the same way that the paid loss projections have. And so I gave those some weight in my projections of ultimate loss. And the incurred losses, not only are they more steady, but they actually are higher projections of ultimate loss. So that caused my projections to be higher. That's the first thing. The second thing is the trend factors, which is how we get from the older years to project for the upcoming year. The Rating Bureau, I believe, uses two methods, 50-50 weight on two methods. One is looking at the total cost rate, the total losses, or the total pure premium or loss rate, trended with an exponential trend, and that's given half weight, and then the other 50% weight is given to an independent analysis of frequency and average claim size. And again, when I look at it, I see that there's been a big change, and this has been reported by the Rating Bureau, that there's been a change in indemnity claims between medical-only claims and indemnity claims. And that, because the frequency and average claim size statistics are done on indemnity claims only, that change in mix from med-only to indemnity is kind of, in my opinion, wreaking havoc with both the frequency and the average claim size statistics. It makes it look like there's a lot more claims, so the frequency is going up, and on the other hand, they tend to be smaller claims, so it's dampening the average claim size. So when you try to project independently frequency and independently average claim size, you wind up with kind of a mess, because they are correlated with each other, with these small claims becoming indemnity claims or not remaining medical-only claims. And so what I did in my projections is not rely at all on the frequency severity method, and relied strictly on the loss ratio method. Losses in total trended using exponential trend, and that also resulted in a higher projection.
All right, thank you.
Okay.
What was the what was the combined effect then of these methodological changes? percentage-wise, and if you can, dollars-wise, approximately?
Well, it's about a 6% increase
Mhm.
in total. I don't know. I don't know what
Well,
the dollars are.
6%. That's
6%. Yeah.
okay. How did you arrive at your high-end estimate for the basic loss experience?
For the basic loss experience, well, so both the ranges, the low and the high, were based on the projections, or the different methods that were provided by the Rating Bureau. The Rating Bureau provides not only the two methods for projecting ultimate loss that I've alluded to, the paved method and the incurred development method. They provide, I don't know, a dozen or so different methods of projecting ultimate loss. And so I looked at the range provided by those different methods and based it on that.
Was that just a judgmental selection, or can you point to?
I'd have to go back and
any
look.
particular
I'd have to go back
method?
and look and see exactly which methods I weighted together to get to that.
Okay. Would you say it was? I mean, the filing itself certainly has the results of those methods. How would you characterize where your high-end estimate fell within the range of those estimates that provided by the WCIRB?
It was, I guess, towards the top, but not
Okay.
at the top.
And percentage-wise, what impact did that have?
About 4%.
Okay. So then you're saying, if I'm understanding this correctly, your middle estimate on the basic loss experience is you think it's 6% worse than the Bureau actuarial estimate, and your worst case is 4% higher than that. I mean,
I wouldn't say worst case, but
your high estimate. Excuse the the choice of words there. Okay, moving on to the SB 863 impacts. I was not able to see what the basis was for your high estimate. By that I mean the low savings that resulted in, the higher end of estimated costs.
I'm sorry. Which end of the range are you?
You provide an estimated impact of
I
the
see.
SB
Right.
863 in total, and you've got
Right.
a low, middle, and high, and I want to know how you arrived at the high
Right.
end.
So that was primarily based on the independent medical review. I feel, and I concur with with Mr. Mudge and Mr. Belusi, who testified earlier, that's one of the most difficult areas of this reform to price. And so I'd say the lion's share of the range that was developed on the high end was less optimistic savings projections from IMR. Is that what you're asking?
That is, I mean, that's a general answer to what I was asking.
I'd have to offline just give you, X% for medical, X% for TD or whatever. I don't have that handy.
Okay, so you did make some choices, but you're not prepared to
Correct.
say exactly where that came
Right,
from.
but I'd be happy to provide those to you.
Okay. I think I understand, how you got at your middle, but with regards to your middle estimates, you're essentially looking at how Texas experience changed when IMR was implemented, and you are...
Well, there were three things, and these were discussed at the actuarial committee. One was, how did California change after the prior set of reforms. And we'll use temporary disability as an example. How much did temporary disability benefits increase or duration increase after the reforms? That was one benchmark. Another benchmark was how much higher is California duration of temporary disability benefits compared to other states. And then the third thing was looking at Texas, and when they implemented IMR, did they at least see, results that were that showed at least as much savings as might be implied by those other two.
But the actual savings that you, what I read is that you observed a 20% reduction or a 20% savings in Texas, and you're assuming some portion of that would happen in California. I think there's a couple of parts to that, but is that...
That's part of it, right. There's also, as I mentioned, so for example, the duration of temporary disability benefits in California, I think, is like 12% higher in California than I don't know if it was Texas or the median of other states or something like that. That was discussed in the actuarial committee as a benchmark of how much temporary disability benefits might decrease with IMR to bring it down to the level of other states or another state that has IMR. Now, neither I nor the Rating Bureau Actuarial Committee assumed that temporary disability benefits would decrease by 12% and didn't take it all the way down there, but that was one benchmark. Another benchmark was how much did temporary disability benefits duration increase post-reform. I believe that was, I can't remember exactly, maybe 25%? Yeah, we're not sure, but it was a very substantial number. And again, let's say it was 20 or 25%. None of our projections were that temporary disability benefits duration would decrease by 25% by IMR, but we did use that as a basis for a range.
With regards to the duration issue, how much, you've attributed some savings specifically to that. How does your estimate compare to what is in the WCIRB's actuarially indicated?
Well, mine's definitely higher. I assumed, I believe, a 10% decrease. The Rating Bureau assumed maybe 7%? Or? Five? Okay. So that would mean that my estimate is roughly double that of the Rating Bureau on temporary disability.
How much would that be in dollar terms?
Help.
About 400 million.
400 million? I'll rely on
the $400 million difference, or a $400 million?
Oh, I'm sorry. The difference is 200 million.
Thank you.
And again, I'm relying on.
Okay.
Yeah.
With regards to the where do I want to? With regards to the medical cost savings,
right?
Explain what you did. How you used the Texas experience.
Okay, so again, there's three sort of benchmarks. You asked about the Texas experience, so I'll give that as the first answer. As I mentioned before, Texas had about a 12% rate of increase in medical costs per year for the 2 years prior to their reform, and then they saw, on average, 8% annual decrease after the reform. So it was similar to temporary disability in terms of the magnitude of the change. As far as the second component of of what I looked at is how much did medical costs increase post the 2002 through 2004 reforms. I think we had a slide on that. It was about 79% was how much medical has deteriorated or costs have increased post-reform. And then the third factor is how how California medical costs compare to those of other states. And that's, I don't remember the number exactly, but I'm sure it's at least 50% higher. And I'm basing that on, I know the Oregon study of California rates shows that we're about 50% higher than the median. And I know we have a higher percentage of our total costs are medical than most other states. So, so those are the three benchmarks. If I had looked at it just like I looked at TD, I think I could have justified a 10% savings because that's what I came up with TD. But I recognize that the medical is it's a little bit, there's a lot of other things going on with medical than just IMR. And the other thing is that I think it's about $400 million over $400 million of medical costs are under dispute, and so it didn't make sense to show savings that were wildly higher than $400 million. And so, so I arrived at a number of 5% for medical as opposed to 10% for temporary disability. Does that address your question?
Okay, I think so. How similar are the provisions of SB 863 with regards to IMR to what was enacted in Texas? Have you considered that?
Yeah, and well, first of all, we don't have the regulations for SB 863 on IMR yet. But my understanding from the folks that I have talked to about that is that it's meant to be pretty similar.
Okay. What considerations have you given to, I mean, how to the similarities or differences between the Texas environment and the California environment? Just in terms of just the whole workers' comp system and how that might affect how IMR plays out in each
Yeah,
system.
it's hard for me to speak to that, but I will say what I considered is that when the reforms were implemented in Texas, it wasn't just IMR. I mean, they kind of do it like we do, right? I mean, we don't just implement IMR, we implement several reforms at once, both with SB 863, and then when we implemented the prior set of reforms, we changed many parts of the system at once. And so when I looked at the Texas system versus the California system, and I tried to figure out what was going on with the Texas system when IMR was implemented, I recognized that there were several parts of the reform that would impact medical. There were some things on spinal surgery, second opinions, and so forth that would also impact medical. And so I didn't. So when I looked at the savings from the reform, I sort of cut those back in recognition that there were some parts that were not directly related to IMR. I did as much research as I could on what was going on in Texas. I couldn't find a report that specifically broke out, this is the savings from IMR, this is the savings from spinal, second opinion, and so forth. So I wasn't able to sort of isolate. So I just had to sort of judgmentally bring it back.
Okay. Do you have an opinion as to what might be the greatest IMR, the greatest percentage of that might be due to IMR? Reasonably.
The greatest percentage of what?
There's some. I'm assuming there's some variability in your estimates of what the impact of IMR might be.
Right.
And I'm asking, well, you observed a 20% reduction
per year for 2 years.
Per year, you assumed that out of 20%, 5% would be IMR. The question is, do you have a feel for what's the largest reasonable percentage that might be attributable?
Yeah, I wouldn't be surprised if it's over 10%. I mean, when I looked at the different provisions in the reform, it seemed to me that IMR was would be the most impactful, and from conversations with people, that was my understanding. And so, so I would say over 10%.
Okay. So we explored the basis for your central or middle estimate. What assumptions underlie? How did you arrive at your maximum, your maximum savings, lowest cost estimate, your lower bound, if you will?
Right. So again, I'll have to give you what the exact assumptions were, but the bulk of it was different assumptions regarding IMR. I agree with the rating bureau that that's very difficult to project the savings from IMR, and so the low end of my range, in terms of the low end rates, assumed a greater impact of IMR, and the higher rates assumed a lesser impact of IMR. As the bulk of it, I mean, there were other things too, but the bulk of it was the impact of IMR, both on temporary disability and medical.
All right. Okay, I want to explore the concept of the range now a little bit. This is a follow-up to Chris's question earlier. Okay. You said earlier, I guess could you repeat for us what you said earlier about
I bet she could.
Which points are
I'd feel better if she did. You're better
at
at
that. I'll ask first, what's your opinion as to what is the most likely occurrence within your range?
I'll say if you of those things that we can quantify, the most likely is what's in the middle of my range. However, I do think that the middle is biased upwards in terms of that the rate is biased high, because there are provisions that we weren't able to quantify, and I believe that those provisions will, on balance, decrease costs, in most particularly independent bill review, IBR.
Okay, well, all right. Do you think that every point in that range is equally likely?
Is equally likely? No.
How likely do you think the top and the bottom ends of the range are?
Yeah, like I said to Mr. Sitko, I didn't assign probabilities to the ends of the range, so I don't have an answer to that.
Would it be fair to say that the likelihood of the lower end of the range, how to put this? You've got an entire range.
Correct.
Right? What is the likelihood, just comparing, what's the likelihood of the lower end of the range happening versus the likelihood of any point higher than the lower end of the range happening?
I think the lower end is more likely because, as I mentioned, the range was developed, the midpoint was developed excluding certain provisions which I couldn't quantify, but I believe on balance that those provisions will end up in savings. And so I believe that the midpoint is biased high, and that I believe that the lower end of the range is more likely to occur than the higher end of the range.
Okay, but putting it another way, $2.38 versus the other choice is $2.39 and above, which is more likely?
I feel like I'm in Price is Right. Come on down. 238 is less likely. Is that what you're...
All right. I think what I'm really driving at is if you were to assume that every point in the range was equally likely,
yeah,
is it not the case that if you choose the lower end of the lowest point in the range, that you are assuming something, you're implicitly setting your choice at something which you believe is, perhaps, well, that it's most like that every other point in the range is.
If you chose the lowest point in the range,
If you chose
which
the
is
lowest
not
point in the range, are you not? Well, let's say you had 100 points. It was discrete, not continuous.
right.
Everyone was 1% likely. Are you not assuming a 99% probability that what will actually happen will be worse than what you've chosen?
Yes. However, I just want to point out that what was voted on and approved is not the lowest point in my range. The lowest point in my range is minus 2.6%, not 0.
Well, like minus 2.6%
relative to the filed rates as of 7/1/2012.
Is that 238 or is that a number higher than 238?
The lowest end of the range is
Yeah.
Is 238 the 0?
Okay. Yeah.
Yes, so it's lower than the 238.
All right. I think I'm done. Thank you.
Okay.
I just have a couple more questions. So,
Sure.
do I understand you to say that in your initial analysis, prior to considering the net cost savings associated with SB 863, that you came up with an actuarially indicated pure premium rate higher than what the WCIRB actuarial committee's indicated rate was?
That is correct.
And that rate is, I'm trying to remember from your papers, but $2.87 per $100 of payroll?
$2.73, I think it was.
Okay, but I gotta get it from Mr. Priven because it's his testimony. It's okay.
Well, I'm just going to read it off of what they.
All right. Well, but it's your analysis, so hopefully.
So the rating bureau indicated average rate, excluding the impact of the reforms, I believe was 273.
But yours, what is yours?
And so mine, I don't have the exact number, but mine is roughly 6% higher than that.
Okay. Well, I think this underscores why I'm going to ask in a moment that one of the department's actuaries come up and put these various numbers up on a screen so we can keep track of it all. But so you were higher than what the WCIRB actuarial committee was indicating the rate would be prior to considering the SB 863 reforms. But the way that you get to a lower middle range number is by, if I understand correctly, considering what happened in Texas and drawing from that to conclude that both with regard to cost savings associated with temporary disability and cost savings associated with medical treatment, that those cost savings are greater than what the WCIRB actuarial committee indicated, and so that's how you get to your middle range figure of 261. Is that correct?
No.
No. Okay.
First of all, my middle range number is very close to what the Rating Bureau Actuarial Committee number recommendation was.
Yes, but what I'm trying to understand again is how you get from higher initial cost pre-SB 863.
So
you've got a wider gap to bridge.
Right. So it's true that it's primarily based on my evaluation of independent medical review, but that was not based solely on Texas. As I mentioned, that was based on how much temporary disability and medical costs deteriorated since the reforms. It was based on a comparison of California and other states, and also what happened in Texas after the implementation of IMR.
Okay, but in all three of those areas, your conclusion is that there will be greater cost savings associated with those things than what the WCIRB Actuarial Committee did, because you've got to bridge a wider gap between their pre-SB 863 actuarially indicated pure premium rate and yours. Does that make sense?
I don't know what you mean by
You start-
I don't know what you mean by I have to bridge
Well,
a wider gap, but yes,
well, you do, I guess.
I,
You don't have to, but you start from a higher.
I have a higher savings
Right.
from the reforms than what's calculated by the Rating Bureau actuaries, primarily based on my evaluation of IMAR.
Okay,
Correct.
and what's the total absolute dollar value associated with those savings to get you from where you start pre-SB 863 actually indicated pure premium rate to where you end up in your middle range projection with regard to the actuarially indicated post SB 863 pure premium rate?
Okay, so I'm not sure I have the exact number to answer your question, but I have on my written testimony to you, I have the exact savings from the reform for accident year 2013, i.e. injuries which are projected to occur in 2013, and that savings, including utilization, is 1.77 billion.
But that's the same figure I heard earlier from the WCIRB that they're concluding will result from the SB 863 reforms.
Okay.
That is their actuaries concluded. The actuarial committee concluded would occur from their SB 863 reform. So I don't understand why your cost savings number isn't bigger, because you start from a higher point.
Yeah, that's probably true. I mean, everything gets converted to percentages. When I have my own estimate of how I think the size of the entire workers' comp pie is, what the entire market is, and I'm gonna base my I project the savings, and then to get a percentage, I take my savings as a percent of the entire pie. The Rating Bureau not only has different estimates of the savings, but they also have different estimates of what the entire pie is, so that when you take a ratio of those two, you're going to end up with different percentages, not only because the savings estimates are different, but also because the estimates of the size of the pie are different. Does that
Okay,
help?
that's helpful.
Okay.
But then to get from your
Thank you.
So what's the additional absolute dollar value of savings associated with moving from your middle range pure premium indicated rate to your low range pure premium indicated rate?
So it's about 12%, and what's the volume of the insured market? Is about 112 billion.
The dollars. I think
Are you just talking about the insurance world or the entire California market,
Well,
including self-insurance and?
I'm trying to figure out what additional increment of savings in the system you're assuming to get from your middle range to your lower range pure premium indicated rate.
And when you say system, you're including self-insurance?
Well, it's your analysis, so I don't know what you're assuming. But my question is, how much additional savings is associated with moving from your middle range to your lower range?
I'm going to say it's roughly 1.2 billion, which would be, it's 12% roughly. And I'd say that the pure premium is roughly 10 billion. And so I'm just, as a rough estimate, I'll say 1.2 billion.
So so where does that come from? Because you're already your analysis concludes that there are going to be cost savings associated with SB 863,
Right.
in addition to those that are
Right.
identified by the actuarial committee in its
Correct.
analysis.
Correct.
And so you point to these three factors that you've testified to, one
Right.
of which includes the Texas experience. But now you're going even further
That's
to
right.
get to your low range estimate. And so where are those cost savings come from, and what is the actuarial basis for concluding those cost savings will accrue?
Okay, so I realize I misspoke. What I was comparing was the low end to the middle end of the range, including both the impact of the reforms and the non-reform. Okay, so if you start out with what my estimates are, excluding the reforms, as we mentioned, mine are substantially higher than those of the Rating Bureau. So at the low end of the range, I'm assuming that the Rating Bureau projections, excluding the reforms, are correct.
Oh my goodness. So
Okay.
you change your underlying assumptions to get to your low end of the range?
Yeah. Well,
I mean,
Yes,
so,
the low-
so you have an assumption for purposes of the high end and the middle end
yeah,
that the costs in the system are going to be higher
right.
as a starting place, but to get to your low range estimate, you then assume
Correct.
the WCRB's estimate
Correct.
of overall system costs and take that as a starting place.
Correct.
Why? I mean, if you're so
Because I think that I think it's a reasonable. I mean, I don't think personally, I don't think that's the most likely outcome, but I think that what they did is reasonable, and so I think it should be included in the reasonable range.
Okay, so then that explains then. So that explains then how you start from a different starting place with regard to the low end
Absolutely.
of the range.
So that's 6 points right there. Sorry. I'm sorry.
I'm sorry.
I interrupted you.
What's happening is she's asking a question and you're like, right, okay. But if you could just fully complete this communication and we'll see that would help me out. I'm sorry.
You're doing fine. You were. Okay, why don't we go back on? So, can you read back the last question?
So then that explains how you, and then how you start from a different starting place with regard to, and then he started the answer that I didn't get.
All right. So the question is that with regard to your low end of the range, you start at a different starting place. You start from the WCRB's starting place with regard to the state of the system pre-SB 863, and then you apply the additional cost savings that you've concluded will occur as a result of Texas and the other two factors that you've testified to get to the low end of your range. Is that correct?
Correct.
Thank you. So, a moment ago, you mentioned that this is a little bit akin to The Price is Right. And it is. I mean, the price has to be right, because if it's not right, we got a big problem on our hands. So what happens if you're wrong about the low end of your range? What if the insurance carriers set their pure premium at the low end of the range and you're wrong, and it turns out to be your middle range estimate? That actually is where we end up in terms of the starting place for costs and the SB 863 cost savings. What happens if you're wrong in
What
the
happens
system?
to whom?
To the insurance carriers. Let's start there.
So the insurance carriers will likely lose money on the policies that they write if they write them at too low a cost.
Okay, and right now they're losing money on the policies they write, correct?
Probably, yes.
Well, didn't you testify earlier that the combined ratios are somewhere above 120 or 130% at this point?
Right, and I'll point out that those are projections, but in all probability, yes, they've lost money on those.
Okay, but do you disagree with the projections?
No, I as I said, they probably are losing money, yes.
Okay, so then if you're wrong, they're losing money now, and they're going to lose more money in the future. Is that correct? If you're wrong about the low end of the range being the right pure premium benchmark.
if I'm wrong, that the low end, that costs
Low end
come
of
in
your
higher.
range, yes.
Correct.
Okay. Can they continue in business if they lose more money than they're losing now?
Well, that's a question for your department to answer, and largely depends on their surplus as well, right?
All right, but given
I
what
can't
you
answer that question.
I understand that, but given what you know about their surplus condition right now,
I can't answer that.
all right, okay, all right, thanks.
I have some follow-up. The information in your submission regarding Texas, it looks as though you've gone to the Texas Department of Insurance website and pulled out information, whether these charts are in them or you took data from them and made these charts. I'm not sure, but I'm assuming since you attributed them to the Department of Insurance in Texas that those charts are from them.
Correct.
Yeah, but you've also pointed out, and I appreciate that you pointed out that IMR was just one part of the reforms that Texas instituted, similar to what California has done at various times.
Correct.
So, I mean, IMR is one part, but then you've listed, 5 or 6 other parts of treatment guidelines, the instituting registration and training of doctors, requiring the use of Medicare reimbursement structure, various things. And all of those could also have affected medical treatment utilization and temporary disability.
And likely did affect it, yes.
Okay, so, but we don't, but from the information you've been able to ascertain, there's nothing that tells us of which part of those components really affected those decreases.
Yeah, that's correct. And I'll give a plug to the Rating Bureau. I mean, unlike the Rating Bureau cost monitoring report, which did break out the savings specifically by component as best possible, the reports that I was able to find from the Texas Department of Insurance did not break it out in that way. I would have made my life a lot easier if they had, but they did not. You're correct.
Yeah, and I think I misunderstood earlier because I thought maybe there was a study, but actually there's been no study concerning that. It's just the information from that Department of Insurance. Is that correct?
I'm sorry.
There's no independent study. It's just what you looked at was information from the Texas Department of Insurance.
I'd have to look back and see if it was done by the department or if they commissioned it. I think you're right, though. I think it was done by the department.
Okay, and then you pointed out earlier that you don't know what their regulations say. That they're estimated to be similar to what we're going to do, but not really gone in and looked at their laws and their regulations to determine, are we comparing apples to apples or apples to oranges? Is that
well,
fair?
we don't have our regulations yet, so I couldn't.
Right.
Right.
Yeah. So we're looking at their example, but it could be entirely different based on the various components there and how they may affect the costs in their system versus California.
It could be different. I'll just say my understanding is that the intent is that it be similar, and that it's the best we have. There's no other state I could find, at least, that was a better example. So, but what you say is correct. I mean,
Okay.
it could be different.
Okay, thank you.
I think there's one follow-up here. You indicated a willingness to provide additional information
Yeah.
as for the basis of your, pieces of your high and
Mm-hmm.
low estimates. Can you do that, and by when? Because I believe the record is scheduled to close at the end of 5 p.m. today, correct, Chris?
Yes, that's correct. Unless you need more time to get the information to us.
End of Monday would be great.
Okay, so we'll note that at the end of the record. We'll change it to 5 o'clock on that day. One additional, the department was provided an analysis that was done by AON, which is brokerage. Have you seen that analysis?
I've seen a bulletin from Aon, which a couple of pages talked about the reforms. I don't know if there's a more extensive analysis. I didn't see any exhibits backing up their numbers, or I did see a couple, like I said, an Aon bulletin which described the results. I don't know if there's a fuller study that I didn't see, but I did see the bulletin, yes.
But according to their study, it seems like the impact is not as great in lessening the costs to California workers' compensation system. Is that correct?
Can you repeat that?
The impact of these reforms is less than what you've predicted, or even the rating bureaus predicted, with regard to the cost. In other words, decreasing the cost of the system. I don't know if, do you recall the numbers?
I do. They project for 2000. First of all, they don't, as far as I saw, they don't say anything about 2013. Right? They only talk about 2014 and subsequent. They do conclude, as I remember, that there'll be a net cost for 2014 and subsequent, whereas myself and the Rating Bureau are projecting a net savings for 2014 and subsequent. They're silent on 2013, at least in what I saw.
Okay. But their projection is for higher cost, or actually less of a decrease in the system. Actually, I think from what I'm looking at with that study, and we'll put this study in the record too, and I don't mean to put you in a position, you haven't had a chance to look at it recently. I don't.
No, I've looked at it recently. You can ask me about it if you want.
Okay. But they're looking at it through 2014 and on. They're looking at a 2.2% industry increase,
right?
Versus what you've estimated and what the Rating Bureau's estimated, which is a net decrease. So there are some actuarial analyses out there that are concerned that some of these reforms will not come out in a net savings to the system. Is that right?
Correct. Are you asking for my comment about it, or that's correct? What you're saying is correct.
If you want to make a comment, you're certainly welcome to. But I'm just looking at the numbers from this study. That it's providing other information and difference of opinion than what you've provided and what the Rating Bureau has provided. But I guess the question I do have is, when you saw this, did that have any effect on your opinion?
No.
And why not?
Well, again, there was no data in what I saw. There may be a study out there that I haven't seen, but in the bulletin that I saw, there were no exhibits to go through, as there is with the Rating Bureau or what I produced or whatever. There was no information provided that you could actually look at and see what their assumptions were. From the verbal description of their assumptions, one of them was, for example, that eliminating Ogilvy would result in no savings at all. That appeared to me to be a biased point of view. Another.
In what was that biased?
Biased towards underestimating savings from the reforms.
In what way was that biased in underestimating the savings?
Because I believe most observers and participants in the system think that if the reform successfully eliminates Ogilvy cases, that will result in some savings. And by saying that there's no savings from Ogilvy, that's underestimating the savings.
But isn't that similar bias in their estimation of what will occur with Ogilvy cases as your estimation as to going to the lower end of your range?
I didn't go to the lower end of my range. I gave a range.
Yeah, but my understanding of your testimony here today is that if you were to pick somewhere on the range, that you would be at the lower end where the public members and the Rating Bureau Governing Committee is. Or am I misunderstanding?
I don't understand how they're similar. I mean, I have a middle estimate based on what can be quantified, and I outlined that there are certain things that cannot be quantified that, in my opinion, will cause there to be greater savings, not greater costs. And so I think that if you just look at the middle of the range, it's biased high. I don't see how that's similar to saying that there's no savings from Ogilvy.
Okay, so you're saying it's biased high. Therefore, you're concluding that you don't have a figure that you would recommend to the department based on your analyses.
That's correct. I have a reasonable range.
Okay, so
That's correct. What I gave is a reasonable range.
okay, and that's why you didn't give any probabilities that, so the selection could be anywhere in there, including where the rating bureau actuarial committee was.
Correct.
Okay. Thank you.
Thanks, Mr. Priven. Appreciate
you.
it very much. Thanks for your testimony. So I think next we're going to hear from public members directly, and I see Mr. Wick coming to the podium. Welcome, Bruce.
Thank you very much, Commissioner Jones. Mr. Sitko, Mr. Dahlquist, could I reasonably anticipate you want to hear how I voted and the rationale?
I think I've seen the vote tally.
So you want the rationale? I will give you kind of how that happened, and then I'll give you the rationale for that. But what I would like to do first, if I could, Karen Smithson Hughes, Nestle Corp., the other public employer appointee, could not be here today. She did give some comments that I would like to share that are quotes from her. Karen is a 34-year workers' comp claims person. She operates in multi-states, so including Texas, so she has a good understanding of the challenges in California and specifics of California. What she said is, I did want to state how excited the employers are on this new bill law. Everyone I talk to gets even more excited as we peel back more and more of this bill law, meaning more understanding of it. And these are workers' comp claims people who are excited, which is not typically what they do. The law shows, I'm continuing to quote her, that someone has been listening to the employers and understands the challenges we face in the workers' comp process every day. Another quote, the new IMR process is huge to the employer. And lastly, the most daunting issue that has impacted the claims world is outstanding liens. I applaud the workers, meaning the writers of SB 863, because there was no end in sight to the liens. Now there is. And Karen voted in favor of the motion for 238. So if I could just share kind of the process of what happened, and then I'll share with you the rationale. I've been on the governing committee since 2008. Mark Priven came on in 2009, and when Mark came on, he started providing for us a range. Typically, the rating bureau has a single number. Mark would provide, again, his low, middle, and high range. And so when he started doing that, a very typical pure premium vote in the governing committee would be that Dave and the actuarial committee would put forth their number, which was usually towards the higher end of Mark's range. An insurer member would motion that number be accepted. It would be seconded by another insurer, and the 8 insurers would vote for, and the 4 public members would vote against. And then we would typically ask the commissioner to consider a number in the middle of Mark's range, which was usually 10% or so different than the Bureau's single number that was presented. So going into this committee meeting that we're discussing, I had spent time reviewing Mark's numbers, his range, and the fact that this time, as he stated, his middle range could not, as the Bureau said, their number could not yet account for savings from medical fees or fee schedules and those kind of things that just couldn't be actuarially quantified. So their number couldn't anticipate savings that were in the bill that we knew would take place, but trying to put a number to it. So looking at several different parts of Workers' Comp Rating Bureau information, my presumption was going in that an insurer would again recommend the 261. It would be seconded, and it would be an 8-4 vote, and then we would promote to you a number, but this time not Mark's middle number, because clearly he said that couldn't contemplate the information and the savings that could not be actuarially justified. So my own thought, and I'll get to the rationale in a minute, was a number around 240 was perhaps more appropriate. And when Mr. Rowe made the motion for a lower number, the 238 number, my thought was that's pretty close to my number, and I thought about it for a little bit and decided to second that motion. There was a significant discussion about that, as Mr. Mudge described, and at the end, the 4 public members did vote in support, and 1 other insurer member voted, and because of an absence, it was a 6-5 vote. So in that sense, it wasn't for me doing something out of the ordinary. SB 863 has created out of the ordinary things for us to address, but the way this happened, I had never had an insurer motion in a governing committee meeting motion for a different number than the actuary presented by Dave Lucy. So I do want to share my rationale for that. I do agree with you, Commissioner, that the reforms of SB 863, while comprehensive and sweeping, it's different than the 03-04 reforms. So I did not anticipate that in a similarity here. I share your concern about insolvency. I saw what happened to employers with the severe number of insolvencies. I saw what happened to employees who couldn't get temporary disability checks, who while a company was being taken into conservatorship, couldn't get medical treatment authorized. It was bad for both employers and employees. So I do, and I appreciate that you bring that concept up, that we need to be aware of insolvencies and the solvency of the insurance industry in general. So that is why I did spend time looking at, and the year I took was 2010. Its recent numbers are, you would expect that even cumulative trauma claims that can be filed after the policy year closes are probably mostly in, so they should have most of their claims. And so what makes up that 138 number? It doesn't include investment income, which for that year was 25%. So we're looking at, and as Mark Priven said, that's an ultimate potential cost that would be $1.13. But what's in that $1.13? There's the claims and reserves for claims that insurers have incurred. Insurers themselves put a 24-point IBNR, incurred but not reported, but primarily, I believe, we're looking at loss development. And the Rating Bureau itself adds another 18 points of IBNR above that. And those things aren't wrong to do, because part of this is understanding, and I think it's part of why there's, understanding Mark's view that without reform, things were potentially worse than the Rating Bureau numbers showed, but with reform were. Our system was completely broken down. In 9 years, hardly anything happened to help our workers' comp system. That's why SB 863 was so comprehensive and so sweeping and took so long for the negotiating committee to work their way through, and I applaud their diligence to go through that. So you have IBNR numbers that are 42 points of the 113. Those numbers haven't been paid yet. Could they ultimately? That's possible. Loss adjustment expense also had gone up 18 points from 2004, from 9 to about 27. So of the 113 number, 60 cents of the number is what the reforms directly targeted, directly attacked, trying to take that number down. Now you can't take it to zero because you'll always need an IBNR number. I really do hope we can get our loss adjustment expense back to 2004 or 5 numbers. So how much of that 60% of the workers' comp dollar can this impact? I hope a lot. The benefit increases are about 5%. And that's a very clear increase, and absolutely employers, those permanent disability benefit increases were negotiated fairly. Employers need to fully fund those. That's 5 points. So you got 5 points here, and 60 points the reforms are trying to attack. We hope there are significant savings when that happens. Another part that I look at, to me, and it impacts, Commissioner, what you're saying about the insolvency issue, that's kind of the phenomenon, is taking this year, whatever round numbers you want to take, insurers filed a average pure premium rate of $238. Their average manual rate was in the range of $330 something, but their average charge rate goes back almost exactly in the $240 range to what their pure premium rate is, which in effect would leave them as a charge rate, a pure premium rate less than $2, unless they're not paying their employees or brokers or reinsurers or taxes anymore, and I doubt that's taking place. So, as you said at the start, this is an advisory rate, and insurers are filing rates, but they're charging rates that are nowhere near resulting in a pure premium rate that you're looking at. So to me, that, and again, we look to the department to say, you know, what does that really mean? And how do we, in a sense, monitor that insurers who have the freedom, as you said, not only to file rates, but then to use their credit and so forth to come down to a particular rate. So with all that in mind, I did look at the range of Mr. Priven's. The low part of his range was 232. As has been expressed, was middle range is that could not account yet actuarially for system savings we know will take place, and that's where I was thinking in the low range of 240. And when an insurer put out a 238, the largest, I believe, single insurer, as Mr. Priven said, someone who you would think would have some of their own statistics. None were given out during the meeting, but they were an entity who did send a letter in the middle of the SB 863 showing that they had analyzed significantly what the issues are, and I would have thought he would have done some pretty significant analysis of his own. So that is why I landed where I was. Again, it was a surprise how that turned out, but I presumed we were going to wind up with the workers, as is typical, with the 261 number, and the public members would have come back to you with a number, but it wouldn't have been much different than what I voted on. And knowing that, I appreciate, Commissioner, your concern for insolvency, and I believe you tried to be balanced and thoughtful and taking all the information in. So that's the information I have to share.
No, it's very helpful. Can I just make one point about the State Compensation Insurance Fund, which is the insurer that you noted made the motion. What's striking about this to me is that when you look at the state compensation insurance fund base pure premium rate that is filed today, after you apply to it as they've done a UCM factor, they're at $4.37. Now I know that there have been these public statements about that insurer filing a rate filing which will decrease their rates by I guess 5%. But right now, with regard to the existing market, they're at $4.37. And I'm eagerly awaiting that filing that will take them down to $2.38 for their book of business as pure premium. We haven't seen it yet. So I appreciate the point you made, and I appreciate your indication as to who made the motion and what weight that had in your decision making. But I think it's important to note that in terms of their rate filing, we haven't seen a new rate filing that would comport with the motion that they made at the governing committee. So I just want to point that out for everyone's benefit. But I really do appreciate your testimony. And thanks for walking us through your assessment and the process you used in coming up with your decision. I really appreciate it.
Okay. Thank you.
Thanks, Mr. Wood.
Good afternoon now, Commissioner.
Afternoon.
Everybody. My
We
name's
don't have
Jeremy.
lunch either, so.
Yeah, I'm the
I apologize.
second to last between lunch and everybody else and lunch, right? My name's Jeremy Smith. I represent the State Building and Construction Trades Council in my day job, but I'm the one of the other public members on the WCIRB. I was not going to go first. I was going to let my colleague from the Labor Federation go first, but I wanted to pick up on your last point, Commissioner, and I will say first that I've been on the board since spring, so I jumped into the deep end of the pool in this world. I'm hoping that your actuary does not start asking me questions about what I'm about to say.
I'm hoping he doesn't ask me any questions either.
Well, good. I'm glad I'm not alone. The State Compensation Insurance Fund, I've heard them described as the insurer of last resort. The point is their book of business is largely construction, and they have a much greater, I was trying to think of this word before I came up here. Given that construction is such a business with lots of injuries, they're going to have a lot more exposure, there's the word I was trying to think of, to having to pay out claims. So I will just say that and then get back to my prepared comments, which are very brief. I will start with, I think, my thesis statement, which is uncertainty should not automatically mean an increase in rates. I'm not the one writing the checks from the insurance companies for claims, I understand that. But I am the one who represents construction workers. And in the construction industry and organized labor around construction, we work much more closely with our employers than other unions that aren't construction. I hear from those employers who employ not only unionized construction workers, but construction workers who aren't in unions, that workers' comp is tough for them. It's expensive. It affects their bottom line greatly. Every employer has to have it in the state, but construction employers, I think, are less likely to try and skirt around the law of workers' compensation, given their exposure, given the workers that they employ. And they have to compete against, they have to compete in the marketplace. And because of the fact that they have such high exposure as employers, their profits are down, which means that they can't employ workers, not only, again, the ones that I represent, but all construction workers. As many people in the room probably know, every economic downturn that we've had, and the one that we're in now, construction is always the last thing to come back. The broader economy always revitalizes itself quicker, and then construction begins again at the end of these downturns. And that's happening now. And keeping a number like $2.38 per $100 of payroll, or $2.40, which Bruce talked about, coming from Mark Priven's study, helps employers and construction industry particularly get back to work, which means it helps the workers that I represent get back to work. I want to associate myself with Mr. Wick's comments. What he laid out as to what happened that day is accurate. We didn't talk to SCIF before we went there. We didn't know that was going to happen. But because it somewhat mirrored what Mark Priven had given us as public members in his study, we felt it made sense to move forward with a vote to have no increase. I also want to just say, in closing, that while you mentioned you're waiting for SCIF to come to you to come back to the 238 number, which, true, I'm sure they won't. I think I explained as to why they can't. Nobody here today is talking about going below the 238 number or the 261 number if in 6 months or a year we find out that the reforms that can't be quantified bring in a gigantic windfall of money. None of us could even wrap our minds around today and even estimate. So we aren't talking about, the insurers aren't talking about going down. I'm sure they could. As I said, I'm new to the board, so perhaps they could file in the next couple of years with you guys to lower rates, the premiums that they premium rates that they charge. I don't think that'll happen. And I'll finally end with this. I was in the room negotiating 863 with employers and other entities. And we raised in those negotiations the stress on the insurance industry. We don't want them to go insolvent. We don't want them to not do business in California. Nobody wants that. But since the 2004 reforms, we felt in the room that workers, especially the permanently disabled workers, had suffered the most under those reforms, and employers had borne the brunt of having to pay higher premiums since those reforms, which we felt like needed to be fixed. And so we did several things in the bill, obviously, to lower costs to the system for everybody. We feel like those things that can't be quantified right now today, understandably so in some cases, should be given time to go online, so to speak, be in effect, and then figure out in the next 6 months or a year how those things are affecting the system and whether or not we need to come back and have a higher per $100 of payroll number. But as of today, we support what we did in the, I support again still what we did in the board meeting that day, the governing committee meeting that day. And thank you for the time to be here in this long hearing. I appreciate it.
Thank you, and thanks for your service and Mr. Wick's service. And I just want to reiterate what I said at the opening. There's no question in my mind that SB 863 is a good thing, and I appreciate the building and construction trades and labor federation and the employers that were involved in the negotiations. And one of the signatory benefits of, no pun intended, of the legislation is the ability to restore permanent disability payouts to what they should be because they were inadequate. And thankfully, there seems to be widespread agreement that at the very least, the SB 863 reforms have cost savings to not only cover the cost of those permanent disability payouts, but some additional net savings. The question is, how much more net savings to the system? And that's what we're grappling with here. Because if we are wrong, I mean, I understand on one side, if we were wrong and there are additional savings and there isn't pricing to reflect those additional savings, then there might be windfalls. But again, I think the legislature could have addressed that by having a provision to claw those back, and I certainly advocated for such, but there wasn't apparently appetite to do that. But conversely, if we're wrong in the other direction, then we could have a real problem on our hands, and that's the central question that we're grappling with here. And I really appreciate your thoughtfulness and the other witnesses' thoughtfulness in trying to assist us in figuring that out.
May I just say one thing?
Absolutely, yeah.
We grapple with that also in all those meetings, both in the short 6-hour meetings we had and the long 15-hour meetings we had on negotiating this bill. It was impossible, and I think you'll harken back to your time in the legislature, for us to put any kind of language in that bill that would have limited what the insurance companies could make. The businesses that were in that room are part of the larger Chamber of Commerce world of businesses, and they had to go back and answer for the negotiations that they did. So putting something in that bill like that, in my 10 years as a lobbyist, I don't think that would have killed the bill. So I'm not trying to be argumentative with you.
No.
I think, though, that could be something that we could look at in the future. However, when you have a governor and you have a legislature that wants to balance the needs of labor and balance the needs of business, something like that is almost impossible to put into a bill.
Certainly, but my point is only that I'm statutorily directed to consider certain things in this process, and if the legislature had enabled me to consider other things, that would be wonderful, and I wished I had that authority, but I don't.
I understand.
And so I've got to stay within the guardrails of this process, and that's where I am. Yeah. Thank you.
Thank you.
Thanks a lot.
Thank you, Commissioner Jones and Mr. Dahlquist and Mr. Sicko. Mitch Seaman with the California Labor Federation. There's not a whole lot left to say. I would just echo the comments of the other public members and our actuary. Briefly mentioning how the 863 negotiations happened and sort of what brought the worker representatives to the table. When we began the process of negotiating the bill, our main focus was basically twofold. We wanted to help address the permanent disability benefit issue while also dealing with delays and the costs associated with those delays, primarily in the amount of time that it takes workers to receive needed medical treatment for injuries sustained on the job, and the dramatically increasing costs associated with that and the long-term effects that might have on overall system solvency. And as we began the negotiations, as Jeremy mentioned, some of which stretched into 14, 15-hour long meetings, the more and more surprised we were at the amount of common ground that there was between us and the employers across the table, that every dollar that they're spending on insurance premiums is a dollar that doesn't go to our wages, that doesn't go to benefits, doesn't go to an increase in or an improvement in working conditions that the employer can't use to invest in or grow their own business, that there was intense pressure on all of us to find ways to reduce those costs while getting workers the treatment that they needed sooner. And the bill that we eventually arrived at and were able to pass through the legislature, we were blown away by all of the components in there that did exactly that did reduce costs, that did get workers treatment faster. But there was sort of hanging over all of that the realization that most of that couldn't be quantified. But going back in my head through all of those conversations, other than the discussion around the permanent disability benefit increases, I remember the vast, vast majority of all of those components of the bill reducing costs, and many of them in ways that couldn't be quantified and will never be quantified. But that overall, we were driven by this constant force of making the system work better, faster, cheaper, even if it wasn't going to translate into a dollar amount at the end of the day. And so when the bill passed, we couldn't have been more excited with the text of it and all the savings that were achieved within it. And I think that's what drove at least my motivation in supporting the motion to not increase the pure premium rate at this filing at the last governing committee meeting, was that just hours and hours of going through that bill and listing out all the different ways that the savings that were going to be achieved through IMR, as was mentioned, the fee schedules, the conflicts of interest, all sorts of different areas of that bill from start to finish that were going to reduce costs, but that weren't going to wind up in any kind of a dollar amount that could be pointed towards, but that we had to find some sort of way of translating that into the original goal of the bill, which was either more money available for wages, benefits, and improved working conditions, or more money available for an employer to use to invest in and grow their own business, rather than just being lost in all these different elements of the system, these wasteful delays throughout the system. So that really drove our support for that motion. And I think the fact that it is, we believe, very much actuarially defensible, as was mentioned earlier, just further emphasizes how important it was for us to find some way of achieving those savings and realizing those savings that were in the bill. And we feel that they have been realized as much as possible, but that the motion made sense, and we voted for it, and hopefully something similar to it stands. So that's all I've got. Happy to answer any questions.
Thank you very much. And I appreciate the Cal Labor Federation's leadership in accomplishing SB 863. It's a good thing.
Thank you.
Thanks. Okay, I just want to make sure there aren't any other public members who wish to testify at this time. I think what I'd like to do now is invite, because we've had a lot of numbers thrown out, and there are a lot of differences in what is being suggested as the pure premium benchmark. I'd like to invite one of the department's actuaries just to walk us through briefly, just to make sure we're all on the same page with regard to what's really before us at this point. So with that, let me turn it over to Gio. And then just to be clear, and then after this, we'll open it up to anybody else who wishes to testify. So those of you who've been waiting very patiently that haven't had a chance to testify yet, will have an opportunity to do so.
You guys got to be nice to me, right?
We will.
We're nice to everybody.
Thank you.
If you could give us your name, even though we all know you up here.
Giovanni Muzzarelli, Senior Casualty Actuary with the CDI.
It's a good Scotch name.
Good Scotch name. Thank you. Again, just want to put together here or review a brief summary of the major issues and some of the various numbers that have been put forth today. High-level commentary. Again, the industry filed pure premium rate of $238 was what was in place as of 7/1/12. Industry filed pure premium rates have increased to $249, reflecting the filings made subsequent to that, and that represents about 52% of the GPW of the market, and is 64 of the top 120 companies have made those filings.
GPW?
Gross premiums written. SB 863 again provides appropriate increase in the PD rates to the injured employees with significant decreases to the system costs, which more than offset the PD increase. And then lastly, again, underlying all this is that premium rates apart from SB 863 continue to show upward cost pressure with adverse development noted by Mr. Belusi for the recent accident years for both medical and indemnity. We can go to the second slide. Yes, I will. And again, this is a slide that puts up some of the numbers that we have previously discussed. On the far left column is the 273. That is the WCIRB's actuarial indication X SB 863.
What does X 863 mean?
That means that we have not reflected any net savings from Senate Bill 863 yet. So that would be the actuarial indication before we overlay the PD increases and corresponding offsetting system savings. For 2013 effective year, the PD increases would increase that 273 to 282. And then again, that's the WCIRB estimation, and then the resulting savings of $1.5 billion as computed by the actuarial committee process would reduce the 282 to a 261, and that was the final actuarial indication from the WCIRB. As we've noted before, 238 is the WCIRB's actual filed pure premium, and that it implies an additional $1.6 billion on top of the $1.5 billion noted above. And again, there might be some slight differences between the numbers that have been discussed earlier, largely due to the fact that in this case I'm using a $19 billion total system loss basis, and Mark Priven, for example, might have used a slightly smaller number. So the dollar figures may be a little bit different. In addition to that, we just want to note again that the changes in the industry average filed figures. The 238, which was the basis for the governing committee's filing. We've noted that filings as of last Friday, I believe, reflect 249. Again, that's 52% of the marketplace. If we actually extrapolate to the rest of the private marketplace, the 249 would become a 257. If we set aside SCIF's 13% of the market and go from 52% of the market to 87% of the market and assume a similar rate increase as has been made by the first 52% of the market, this would extrapolate to 257, just for an informational direction indication.
And those are pure premium rates?
Yes, these are pure premium rates. Thank you. Okay. And we also have one additional slide, which we'll bring up. Okay. And again, just a few additional figures to put forth. The left-hand set of columns for WCIRB actuarial indication we've just talked about. Mark Priven's Bickmore midpoint figures are in the middle set of columns. And I believe the commissioner had referenced the 287 figure as the pre-SB 863 midpoint estimate from Mr. Priven, which would compare to the 273 pre-SB 863 central estimate from the WCIRB actuarial committee. Mr. Priven's figures increased to 295 with his assessment of the PD increases, and then the decrease down to 261 reflects the larger assessment of savings from SB 863, which he had computed. Using a similar base of $19 billion for system costs, Bickmore's midpoint savings equate to about $2.2 billion as compared to the $1.6 billion, or excuse me, $1.5 billion corresponding to the WCIRB's actuarial indication. And then lastly, it was noted that Aon Brokerage had put forth a newsletter to their clients in October. Their opinion of both the PD increases and the system savings from their perspective, and they assume a larger PD increase than what has been reflected by the WCIRB's actuarial committee, as noted in their document, due to their belief that utilization is going to be greater. They use the term nonlinear relationship, that because the PD benefits are increasing, there's going to be a greater effect than what has been reflected in the WCIRB's figures. They also share a concern that the system savings are going to be somewhat less, approximately 50% that of the WCIRB's actuarial indication. And as Mr. Priven noted, they don't have detailed documentation in their write-up. They do put forth some bullet points as to why they believe that to be the case. And I think an important point here is recognizing the probability that things don't work out as all the participants hope that they will. I think that may be what Aon is reflecting, is the fact that there's some probability that the system does not react in the most favorable manner that has been anticipated in the language of the reforms. And what these figures here represent is the net effect from Aon, assuming the same starting point as the WCIRB actual indication. 273 is the same starting point. They've got a bigger PD impact, a smaller savings impact, and their net effect is a positive figure. And again, that's an additional third party's perspective.
Okay, all right, that's very helpful, because I began to get a little lost in all the numbers. We seem to need a taller podium for you.
Yeah, shorter legs.
Yeah, very good. All right, thank you very much.
Sure.
So why don't we turn now to any other members of the public, and I appreciate your patience, and see if there are any other members of the public who wish to testify at this point in time. We have a list. Maybe what we'll do, just to do this in a, do you want to just call them out by name, or do you want to folks just want to come up?
Mr. Sexton, I see you standing up ready to go. You're on the list if you'd like to speak at this time. Yeah. Did you bring a business
card? Okay, so anybody who's going to speak, if we could get your business card so that the reporter would have your contact information, that would be wonderful. And you don't have to provide it right at this instant, but maybe at the end of the proceeding would be fine too. Thanks, Mr. Sexton.
Mark Sexton with the Association of California Insurance Companies. I know you've all heard a lot, and like you, I'm completely lost in the various actuarial assumptions. So I'll try not to spend too much time on it, except acknowledge that right now California faces a major crossroads in the workers' compensation market. The legislature, as we've discussed for the last several hours, has passed major reform, but as has often happened in the past, both in 1993 and 2002, 2004, we spent a lot of time trying to determine what the reform actually does. And we also have a problem because quite often the reforms are based on regulations or changes in practice that we don't know if they will actually occur. I happen to be involved in the 899 development, and I know there were lots of things in 899 that we drafted that sounded like a good idea that turned out not to work anywhere near the way we expected them to do. I'll give you an example. One of the issues, of course, bump up, bump down, the 15% up and down, we thought was a great idea to try and encourage employers to bring workers back to work. We didn't realize this when we put in the one-year rule. We excluded most construction, entertainment, and other temporary employers. We didn't think about that. We were worried about employers using it as a management tool to get rid of employees and still use the 15%. That's been taken out here because it clearly didn't work. We are operating on an assumption based on regulations that we have not only not seen yet, but haven't actually been released. As an example, one of the regulations that has been released is the spinal surgery. That's a small cost savings anticipated in all the various reviews. The first set of regulations, if you looked at them, and then you looked at the second set of regulations that just went out for a 15-day review, you will notice that the savings already within that single set of regulations already, I believe, needs to be decreased, because the surgery centers and the hospitals who were concerned about spinal surgeries were able to get changes in the regulations that we think will drive up costs. Independent medical review. Now, I have to say I'm a big fan of independent medical review. I was advocating it in 2002 when Jackie Spear was thinking about it, so I'm a big fan. The challenge is we don't truly understand exactly how it's going to apply in a workers' comp setting. In group health, and I helped draft the bill that's set up in group health, it's very clear. We don't fully understand in workers' comp. Does it apply to all medical decisions? When you talk to some of our folks, they'll say it's going to have very little impact because very few disputes are based strictly on medical decision treatment decisions. But then when you talk to other people, we had a meeting on Wednesday, they're talking about there possibly being 100,000 cases that'll be submitted to the enrollment contractor, who is Maximus. Maximus currently handles around 2,000 cases for the Department of Managed Health Care. How are they going to deal with going from 2,000 to 100,000? But to use the word today, the range of cases that are possible are amazing. Liens is another example. During the legislative process, the three groups that you've talked about, the Rating Bureau, Bickmore, and State Fund, provided cost savings estimates throughout the process. One of the elements that we had a huge concern was the projected lien savings, particularly those by the State Fund. And one of the reasons you might have seen much larger lien savings attributed to State Fund is probably because they have a much larger percentage of liens in the marketplace. I have some companies that don't have any liens. So the lien savings inherent in here will not apply to those people at all. We also, of course, and I talked a little bit about it, we also have the law of unintended consequences. There is yet to be a workers' comp bill that is drafted that has worked anywhere near the way we anticipated it would be. You go back to the 1993 reforms when we developed the treating physician presumption, there we thought was a great idea. By 1996, as the courts expanded what the treating presumption stood for, you then saw the industry in complete collapse, as you mentioned a little bit earlier, in 1999 and the year 2000. You have spent, and your office has spent, a lot of time with this pure premium advisory rate, both to explain what it is and is not. It is not a rate setting obligation, it is an advisory rate. And also to take it away from where we saw with the last commissioner, where many of the decisions were made based on political determinations and his desire and expressed desire to keep rates down, as if he actually had that authority, and the data that was coming in not only from the Rating Bureau but also from your own staff. We went through 3 periods where there was absolutely no increase, and that led to a situation that we have now where we're kind of in flux, and we really do appreciate your efforts and your staff's efforts to re-energize and reinvigorate this particular process, because we think that it's an important process. It's an important process for us to get a snapshot on what is going on in the workers' comp industry, not only for employers and policyholders, but also for policymakers. And so it's very important we keep this as close to as we can. There has been some talk about solvency. That is an issue. Quite frankly, that was an issue we saw coming up. You know what the loss ratios are. You know, in 2002, 2003, they were over 160%. Some carriers were as high as 175. That was part of the impetus for some of the reforms, and a lot of the decrease, or as Mark Priven refers to it as windfall, actually went into rebuilding reserves that a lot of the insurers needed after that time period. Right now you see the ratio at 138. One of the reasons for this bill was to deal with the stress in the insurance industry so we can maintain a healthy marketplace. I don't know where Mr. Wick gets his 25% investment income. My 401k certainly hasn't seen that. You as the regulator know that most investments by insurance companies, by both your rules and NAIC rules, have to be in low-end bonds, highly secure, highly liquid, but pay next to nothing. So I think we need to keep that. Adequate rates and a perception that rates are going to be adequate helps us, because it helps provide for a healthy marketplace. You know, that you look at Aon and you look at some other stuff, these are the tools that insurers look at as to whether or not they want to, A, expand in California, or in some cases enter in California. Remember, the capital gain here in the United States is not just for California, but it's for other states that might have better markets, or for other countries that might have better markets. So if we want to maintain a active, healthy market here in California, which is the best thing for employers, we need to make sure that rates are adequate. Another thing, during the entire legislative process, and we had meetings with Christine Baker on a number of occasions, we had meetings with the governor's office, the message we kept doing, which they kept saying, is this will not result in rate cuts. It was not designed to do in rate cuts. As Christine Baker once said, is it will moderate the rate increases because we already had a system that was already stressed out. So we ask you to, as you're doing here, take a hard look at the actuarial numbers and try and rely on the data that's been provided to you. Thank you.
Just a question, Mr. Secretary, and I appreciate your testimony. One of the things that I mentioned earlier that is troubling to me is that when the governing committee made its decision, it had in front of it the filed average pure premium rates as of July 1st, 2012, even though it was making its decision in late September, early October. And as we know now, the filed average pure premium rate is $249, which reflects admittedly not all of the market, something on the order of 52% of the market, but our actuaries have done a extrapolation assuming that the trend of filings continues as it has, and that takes us to potentially $2.57 average filed pure premium benchmark. So the question is this: the market does not appear to be responding in quite the way one would predict it should respond, given some of the assertions that have been made by public members and Mr. Priven and others with regard to the cost savings they project from SB 863. And to be very, very blunt, I'm interested in what your response is to what I think would be their question. Were they able to ask you the question? And that is, what confidence do we have, even if as they assert, and you can question those assertions and you can question the actual basis for those assertions, but what confidence should we have that if the additional savings that Mr. Priven and the public members are asserting will accrue, that will actually be reflected in the filings of insurance carriers? I mean, their argument is essentially, we're going to do all these savings, but the carriers will be positioned to continue just to increase rates as they see fit to garner substantial increased returns, and that the savings will inure principally to some component of the net savings will inure principally to their advantage, not to employers and not to injured workers. So it's a long question, but I think you get the gist of it. So what response do you make to that?
My opinion only, because I can't speak for the industry, because quite frankly, we're not nearly as organized as people think we are. I think if you look at the rates that came out of the 2003-2004 reforms, where you were dealing with, I believe, like $6.25, and now you're down to $2.30, I would suggest that most of the savings have been passed on. I think when you look at the adjusted loss and the combined ratios, where we're actually paying out $1.38 for every dollar that we're bringing in, which to me is not really a long-term business strategy that's going to be successful, I would suggest that we could possibly be passing on not only all the savings that we've seen out of SB 899, but indeed more savings than were actually inherent in 899. This is going to be a challenge having two SBs both in the 800s. And I think as long as we work to maintain a competitive marketplace and a healthy marketplace, I think the market will take care of that. There are a number of different companies in here. As long as we can keep the number of companies here, and in fact maybe even encourage additional companies in here, there are always companies that are willing to move into a state that they think they can make a good investment in, and they will often drive prices down. That's what we saw after the imposition of the minimum rate law. Now, of course, for reasons that we could probably spend another hour on, it didn't work so well for a lot of companies. We saw a lot of new carriers come in after 2000, 2004 that brought the rate down, and I would anticipate that once carriers become comfortable with what really is in this bill, I mean, it's nice for us to hope we know what's in this bill, but what actually is in the bill and how it actually operates in the real world, I think they'll come in. Because we also have to pay attention a little bit to the 3 rules of workers' comp, which is the bill never works out the way you thought it was. The courts interpret it in ways you never thought imaginable, and some entrepreneur will figure out a loophole in that you never even dreamed of. And it's happened every single time, and it will happen here.
Okay, very good. That's very helpful. Thank you. So others who have indicated they'd like to testify, or even if you didn't so indicate, why don't you come forward now and tell us your name and your affiliation. Welcome.
Good afternoon, Commissioner Jones. I'm Richard Markison with Pacific Advocacy Group. I'm here representing the Plumbing, Heating, Cooling Contractors of California and the Air Conditioning Trade Association, 2 of the construction industry groups that are supportive of keeping the advisory rate where it has been proposed. But we are also a little bit concerned about the changes that are being proposed for the threshold for the dual rate. That specifically affects smaller contractors and residential contractors. And as concerned as we are about keeping solvency within the insurance industry and keeping a vibrant workers' compensation industry available to sell the product in California, we're also very concerned about the solvency of small contractors. Unfortunately, we haven't had an opportunity to completely quantify what the impact would be with those changes. However, we are concerned that it will have an impact and could throttle back the rather modest recovery that we're seeing in home construction right now. Thank you for the time to address you.
So can you share with us, so you're talking about a particular change in classification or other rules
for the dual
associated
rate
with
for plumbers and for sheet metal. Our concern is that by raising that threshold for the lower premium rate, smaller contractors, contractors who are working primarily in the home construction area, who are paying the lower average hourly rate, in that range between the 24 and what is being proposed for 29 for the threshold, are going to have additional premiums that will be associated with that change in the threshold, and that's going to affect their bottom line.
And do you recall the specific class or classification that we're talking about here?
It's the two classifications that are in the handout, one for plumbing and one for sheet metal.
Okay, and then what would you advocate we do in lieu of that?
That's a difficult question, and I'm certainly not an expert in workers' compensation. And I understand that it is a complex issue. And our bottom line concern is that by changing those thresholds, that there will be kind of a bottom line impact on the contractors who are paying in that range and would be seeing a workers' compensation premium increase for someone, say, who's taking advantage of the lower rate at $25 or $26 an hour. Now they're going to be paying a higher rate until they get up to the 29 or 20, whatever is being proposed for the change.
Okay, and then maybe we could hear from the WCIRB on that particular item, if we could, because I don't know we've got any testimony specifically from the WCIRB on why they're recommending that particular classification change. And if there isn't someone here to provide that, then maybe I think we're going to keep the record open until
5 o'clock
on Monday. And so if we could get a further articulation from the WCIRB as to that particular one, that'd be useful. Is there someone here who can speak to that now? There is. Okay. All right.
I do have one question for you before you leave, and the dual wage is something that we have struggled with dealing with these rule changes for so long. My understanding is that the Rating Bureau, and they'll talk to this or speak to this, will be that they've done studies on inflation and what has occurred out there. And that what they're trying to reflect is, even though the economy has been down, that there still is wage inflation that is occurring. They're just trying to reflect that to keep things balanced. In other words, what may happen is that as wages rise, we have a situation where more employers are going into the lower rate, and it's not truly reflective of the loss that's occurring based on where that division in the wages is because of the inflation. And is that your understanding also?
Well, and certainly there has been wage inflation or wage increases, but we've seen those primarily in the prevailing wage classifications. That we've actually seen some wage deflation in home construction. Some crafts right now are I guess you would say they're weathering 40% unemployment, and in those cases where there's significant oversupply of workers, we've actually seen some wage deflation, primarily in residential construction. And so The push certainly has been, or the increases have certainly been on the higher ends of the income and primarily in prevailing wage. We haven't seen the same kind of pressure in light commercial and also in residential.
And that's exactly what you've answered my next question, is I wanted to see, or ask you what you've seen in the industry, and thank you for that.
You bet.
But are the crafts doing the residential home construction? I thought that most of the crafts were not any longer doing residential home construction work.
Oh, absolutely. Residential, I mean, the 25 or so thousand housing units that we'll build next year in California, down from a high of about 250,000. There's still, although there are general contractors who will typically do the carpentry and maybe a couple of other associated tasks along with that, particularly for electric, for plumbing, and for HVAC, those are being performed by subcontractors who are the specialty contractors under the Contractor State License Board.
Okay, and you're here on behalf of the
heating
and air conditioning contractors
and
the plumbing contractors. Yeah. Okay.
Thank you.
Thank you very much. And so let me give Mr. Bellucci a chance to respond then too, if
yes, I'll just give you kind of a general background
right.
about the process, and if there's more information, we'll provide it, before the record closes on Monday.
Well, let me just ask you before you begin. You did provide to us the studies that you've done that support these changes. I know that you've been working on this extensively.
Did we provide those studies?
Did we get this? Did
yeah, so I guess they are already in the record.
Okay, all right.
So
good, and we'll review. We are reviewing those, and we'll look at them again in light of this testimony.
So, essentially, without going getting bogged too much into the history, California has a system, kind of unique, where for 18 construction classifications, they're segregated into 2 based on hourly wages paid to their employees. The idea being is that the losses per $100 of payroll have historically been significantly higher at low wage paying employers than they were for high wage paying employers. So to increase the fairness of the system, basically there's 2 classifications and split at a particular point, which is the threshold, the issue that was raised by the gentleman. And so for each classification, there's a threshold that's established at a level that the goal being is you have a significant wage loss differential between those below the threshold and those above the threshold. You have relatively few employees right at the threshold because you don't want big shifts for small changes in wages, and that both sides they're fairly large, so you can come up with a credible rate. You have a big enough group below the threshold and a big enough group below the threshold, so in both cases you could develop a credible pure premium rate. So that's sort of the basis. These have been in place for the initial classes back from the late 80s in California. So for a time, and I'm thinking it was roughly 4 years, there had been no dual wage threshold. Some of the concerns, we all know the recession hit construction particularly heavy. It didn't hit all construction segments the same or at the same level and at the same time period. So for a period of around 4 or 5 years, there hadn't been any increases in the dual wage threshold. So in the last 2 years, what we've been undertaking was a number of studies related to the dual wage threshold, one of which was, should we continue it? And we're recommending yes, it does work better than the alternatives we looked at. But then secondly, we're in the process of conducting a series of surveys where our staff goes out and interview individual employers in each of these classes and get a distribution of how their wages are being, what wages they're paying to their workers in these classifications, and then matching them up with loss histories to see that we have the right thresholds in place. And so what was represented in the filing for this year was a series of changes for 11 or so of these construction classifications that were based on this most recent survey information. Again, the idea of getting the best threshold for that classification that most appropriately segregates it into the 2 pieces. And by best, we were looking for, again, those 3 or 4 criteria: big enough, not too many employees right at the threshold level, and then that you had a very significant differential in loss experience between those employers with average wages below the threshold and those employers with average wages above the threshold. And those recommendations that were part of our filing submitted in August reflect those studies.
So that, if I understand that correctly, so you're proposing then, based on those surveys and studies of what's happening in these various submarkets, to raise the threshold in some cases, I guess in this particular case, for plumbing contractors and for sheet metal and air conditioning contractors. And the net effect of that will be that there will be more of their employees that will fall below the threshold and potentially be classified in a way that would result in a higher payment of workers' compensation premium and less employees above the threshold, because you're moving the threshold up. Is that, do I have it right?
For the classifications, there were some that we didn't propose changes, but yes, for those
these,
classifications.
For these two, it sounds like what the prior speaker was concerned about is the thresholds going up.
Yes, and those are recommended. And part of that is, in an inflationary world, if you don't, ultimately everybody ends up in the high wage class anyway. So to keep over the long term, there needs to be increases to kind of keep in that threshold, because as wages move up, you need to keep the thresholds need to change to kind of keep the program viable. So to some extent, it's a reflection of the inflation that's happened in the 4 or 5 years since we've last increased it, and some of it's based on what we saw in the individual classifications.
But the assertion was made a moment ago that in the context, I guess, of now I'm paraphrasing, but commercial work where prevailing wage would apply, there has been inflation, but in the light commercial or residential area where prevailing wage doesn't apply, there's been deflation in wages. I'm just curious what response you would make to that, to what was testified to a moment ago, in terms of what impact that might have on your thinking about the threshold.
Well, that's not a segregation we've looked at in these classifications. What we have looked at, besides the surveying of employers in these classifications, which presumably would represent some in the residential area and some in the more prevailing wages, we do look at some measures of inflation by industry that the state publishes, and those tend to often, again, also be at a trade level and not have the differentiation between segment a particular trade between more residential and more prevailing wage type work. So we've not really looked at that issue and that kind of differentiation between that segmentation.
But as far as you know, you didn't just survey the heating and air conditioning contractors and plumbing contractors that are doing commercial work where the prevailing wage might apply, and leave out of the survey those that are doing, and I don't even know if the industry divides itself this way. I'm guessing they probably have a share of all of it, but I don't know. But you didn't leave out of the surveying with regard to what's happening on the residential or light commercial side, as far as you know?
No, we did not. Our survey was based on a random sample of all employers in those classification that reported payroll within that classification. So there's no reason that we didn't have a representation of both of those segments that's roughly proportionate to their representation in the California market.
Okay. All right. Thank you. It's helpful in understanding.
All right. Do we have anyone else that would care to provide public comment? Okay. Seeing that we have no others, if you would like any closing comments, Commissioner?
Well, I just want to make sure, so there are really two items we're hearing here. One is the pure premium benchmark, but the second is, as we just got into a little bit a moment ago, the issue of the classifications and other rules associated with establishing pure premium benchmark rates across classes. So I just want to make sure that the public is aware of that, and there's an opportunity to testify on both, and that nobody is here that wants to testify on the latter of those two that didn't have a chance to do so. Okay, we've worn you down. So I just have a few, I promise, closing remarks. So as I said when I opened the hearing, my responsibility is to evaluate the pure premium rate filing by the Workers' Compensation Insurance Rating Bureau, determine if it's reasonable, well supported, and adequately reflects the cost for the next workers' compensation insurance policy period. That decision is an important one. I think one of the witnesses referred to it as the price is right, and I couldn't think of a more apt metaphor, because if we don't get it right, it could have very significant consequences for the solvency and viability of workers' compensation insurance carriers, and in turn for the availability of product in the market, and in turn for the pricing of product in the market, which has potentially significant consequences for employers and their ability to hire more employees. And I did spend some time in my opening remarks, I won't dwell on it, with regard to what happened in the late 90s, early 2000 here, when the price wasn't right and the market collapsed. So we've heard testimony today that there is a stark difference between the actuarially indicated rate that was calculated based on the Workers' Compensation Insurance Rating Bureau's actuarial committee and the rate that the Workers' Compensation Insurance Rating Bureau Governing Committee recommends. That is of concern to me, and we've taken a lot of evidence on the process, what was considered, what wasn't considered. As I alluded to, one concern I have is that the governing committee, in making that decision, did not have in front of it an up-to-date data point with regard to the actual filed pure premium rates as of the date that they were making their recommendation. They were relying on a filed average pure premium rate as of July 1st, 2012, not as of late September when they made their decision. And that's of concern to me, because it does strike me that to some extent what the governing committee did was just default to what the filed average pure premium rate was, or what they thought it was, which was in fact not what it was, because they didn't have updated filed average pure premium rate information before them. So that is of concern to me. I'm also concerned about the actuarial basis for the decision that the committee made. Now, I want to underscore something I've said throughout the hearing, and that is I agree, and I think there seems to be unanimity of opinion, that SB 863 is a good thing. In fact, prior to the enactment of SB 863, I testified before a joint legislative committee of the legislature and testified that costs were increasing in the workers' compensation insurance system, that combined ratios exceeded premiums by a significant amount, that insurers were paying out more than they were collecting in premiums, and that ultimately this was not sustainable in the long run. And I said action is needed to address these increases. And thankfully, thanks to the leadership of the California Labor Federation, the building construction trades, employers, and others, they blazed a path and came up with a very significant and thoughtful series of reforms that not only allow us to make sure that we're dealing with permanently injured workers in a more adequate way, but also provide for cost savings to offset those permanent disability payouts and net additional cost savings. But herein lies the question that's before us. How big are those additional net cost savings? And that is the question that we're going to have to decide in issuing a pure premium advisory rate filing. Now, I also want to underscore that we're most appreciative of the governor and his staff and his leaders at the Division of Industrial Relations as they're working on regulations to implement SB 863. And I've talked to the director, I've talked to the governor's senior staff. We're offering assistance, technical advice, and support in whatever way they deem helpful, because we have a common goal. I think all of us in this system, employees, employers, insurers, the public sector, all have a common goal in getting these regulations done, making sure they're robust, and making sure that they effectuate the goals of the legislature and the governor and all the stakeholders in enacting SB 863. So we will continue to work closely with the Brown administration to do precisely that. I also do appreciate the WCIRB's thoughtful comments and others' comments as well with regard to the importance of monitoring the implementation of this. I know that we're going to have to watch that closely, and I expect to hear from the WCIRB as they're doing monitoring with regard to what they are seeing as we implement SB 863. And I'm most appreciative of their attention to this, because it's critically important that we stay on top of what's happening. Now, there are also additional reforms that were not a part of SB 863
that for whatever series of reasons could not be effectuated. And so I want to add that I think it's important that we do revisit some of these additional reforms. These include addressing through legislation and regulations ongoing problems with the overuse of powerful and addicting pain medications, and reviewing reasons for increasing cumulative trauma claims and post-termination claims. And there are others as well. I think it would be a mistake for all of us to conclude that our work is done here, because I think there are more cost savings that could be obtained, and I hope that the legislature and the governor and the stakeholders will continue to look for additional opportunities in this regard, because even if things play out as everyone hopes, we are still going to be at a place where our rates are significantly higher than many other states in the union. Now, there are some good reasons for that, but there are also some frictional and transactional costs associated with that I think we could continue to look to address. So we must be prepared to make adjustments, to add to improve the SB 863 reforms as we learn more through the monitoring and as we see additional opportunities. So I really want to thank all of those who hung with us throughout the entirety of this hearing. I know there are probably many in the audience whose eyes began to roll back into the backs of their heads as we were engaged in the actuarial conversations, but it's incredibly important. Perhaps no better example of the importance of math was demonstrated on November 6th, where one group of people got the math right and another group of people seemed to be engaging in magical thinking with regard to math. And I think it's critically important we not engage in magical thinking. Regardless of where you fall in that partisan divide, it's critically important we not engage in magical thinking, particularly as it relates to workers' compensation rates and the pure premium process. So with that, my thanks. I really appreciate your attention, the thoughtfulness, the responsiveness to all of the questions that we posed to you, and we look forward to issuing an advisory benchmark in short order. Thank you very much. And with that, Mr. Sitko?
Yes, I just have some final housekeeping and closing items. As we have noted here, the record will remain open, but it shall close on Monday, November 19th, 2012 at 5:00 p.m. I did receive today the document here from the PowerPoint of the Rating Bureau. I'm going to put this in the record. We also received a disc which includes their notifications, bulletins, and wire stories, which we will put into the record. We will also put into the record the PowerPoint from the department, which summarizes generally the figures that we received today. We have already included in the record Rating Bureau's filings up to the date and the various reference materials that they've submitted, the comments of the public members and the and their actuary, and then the actuarial analysis of Aon from October 2012, which is a bulletin that they issued. I believe that summarizes everything that we've received so far that's in the record, and again, we'll receive other things until Monday at 5:00. And with that, I am concluding the hearing today. Thank you.
Thank you.